Minute to go until the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. The Swiss central bank provides Credit Suisse with up to 50 billion francs of liquidity, hoping to draw a line under the crisis. While shares are actually expected to soar at the open as credit risk falls. We'll be live in Zurich. European stocks is set to jump after Credit Suisse taps the S&P for funds, but also looks to buy back debt. Treasury yields rise, and of course, it's the ECB day. The recent banking chaos throwing into question whether we'll get a 25 basis point hike or another half a point from the European Central Bank. Now, let's take a look at the futures. I have to say the focus is firmly on bank stocks. So as soon as those open, we'll see whether there's a bit more stability. It feels like not only regulators, S&B, but FINMA over in Switzerland have tried to throw everything at it so that there are no more questions about liquidity, that there are no more questions about the facilities that they can draw on. We also heard from the chief executive of Credit Suisse just moments ago, putting a statement out saying, like, look, this shows that they mean business. And of course, this means that they can get away from what happened yesterday, where we saw the share price down 24%. So this is a picture overall for European. Look, futures for the moment are pointing to a higher start. The picture overall is one of course, more stability than there was yesterday. If you look at the Swiss franc rallying on the news in a volatile trade after a sharp sell-off, that was yesterday, and then the euro strengthening slightly ahead of an expected interest rate increase from the European Central Bank. We could take bets on how many questions Christine Lagarde will actually field on Credit Suisse and the stability of the banking sector overall in Europe. This comes after, well, days after we had the failures of 3 U.S. banks, the latest bout of market turmoil, of course, threatening to rewrite the global outlook. Spanish IBEX, but also the CAC 40 and the FTSE gaining some 1.3% at the open. So the picture overall does seem one more of stability. We'll see what happens in the next couple of hours. The other question we need to ask ourselves, apart from the ECB, that will give us hopefully a good indication of what they see as the strength or the weakness of the financial system as a whole, is maybe any bets, further bets on the Federal Reserve, whether they will increase interest rates when they meet next week. So this is a picture overall for markets, potential lifeline for Credit Suisse as it seeks to weather a crisis in confidence by borrowing up to 50 billion francs from the Swiss bank, National Bank. Now, the lender's top shareholder, the Saudi National Bank, also trying to calm the markets, saying the panic is, quote, unwarranted. But yesterday, the S&B did the opposite, alarming investors by telling Bloomberg it was not willing to inject more cash into Credit Suisse.
For many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
So far, it's pretty calm. We even saw material good inflows yesterday still. Also, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days to look at that.
Well, we have team coverage this morning of the turmoil surrounding Credit Suisse. Oliver Crook, live for us in Zurich. Tom Metcalf, of course, here with me in London. Jan Henrik, also here looking at the fallout from Credit Suisse. So let's kick it off with Oliver Crook, who's in Zurich. So, Ollie, what's the latest on the ground?
Yeah, what an incredible 24 hours on this Credit Suisse saga, really precipitated by those comments from the SMB, the Saudi National Bank, that sort of began this whole process and these aggressive moves to the downside yesterday. And really all of yesterday, we were waiting for what could stem the bleeding here, and we were waiting to hear something from, well, in the end, the SMB. So we heard that they were in talks with Credit Suisse and FINMA, and those talks sort of bore fruit at 2 a.m. with a sort of a lifeline. So here, you know, it's not always that the Bloomberg and the Swiss national newspaper share a headline, this saying Credit Suisse in crisis, the national bank throws a lifeline, and this is the lifeline that we're seeing in the market today. I don't know that we have an opening print yet. Indications in the pre-market were up 20% for Credit Suisse, so seemingly having its intended effect this morning.
Seemingly, and I have to say that they threw quite a huge lifeline, and also trying to do everything they can to stem this crisis. What's the mood like on the ground? I know you've looked at the papers. Oliver, are people worried? Is there chatter about Credit Suisse? I mean, you know, they have two banks. This is like a national jewel.
Of course, and so this is a globally, systemically important bank. This we know, which is why we see the sort of the fear rip across the market, but it's a critical bank for Switzerland, for Zurich. I mean, they have retail banking, they have commercial banking. It's really part of the lifeblood of the economy here. So I'm just speaking to people kind of walking by the street, just kind of what they make of this. The one person I spoke to was sort of a lot of like head nodding, you know, in kind of dismay, saying, you know, just sad for the employees there, that there are thousands of them. There's a joke apparently going around that you can go get a coffee for 3 Credit Suisse shares. On the other side of that, we spoke to somebody else who said, allegedly, he bought 50,000 shares in Credit Suisse yesterday on the bet that these shares would come back up. And if that's true, he's made, you know, a fairly decent profit this morning.
Yes, because the share price just opened some 40% higher. Credit Suisse 2.38. Oliver Cook, great work, of course, on the ground there, very close to Paris-Darplatz, where you have Credit Suisse and UBS close by. Now, staying on our top story, the world's biggest banks racing to shield their finances from the potential fallout. Let's bring in Bloomberg's Jan-Henrik Forster and Tom Metcalf. Thank you both for joining us. Jan-Henrik, first of all, there was definitely a sense of panic in the markets. Was there warranted? Because if you look at the figures of Credit Suisse, certainly they could cover a lot of the liquidity ratios. I mean, they have cash and they're pretty well capitalized.
Yeah, absolutely yes, I would say here. Look, Credit Suisse is a globally a G-SIB bank. They have liquidity and they do have capital. But at some point, if your share price is being hammered and you're in the news all the time and you have one bad news after another, it's becoming a confident crisis. And this is what's basically the situation here, right? And once people start pulling deposits, we don't know if that happened, at some point it becomes a liquidity issue. And you probably, you have to consider bolder actions. And this is actually what happened here, right? A bank having to tap the Swiss National Bank for liquidity, it's as worse as it can get. Like, this is really the worst case situation. Maybe they are buying a bit of time. It doesn't solve any problems, right?
Yeah.
So we published a story yesterday that, there might be even a merger discussion with UBS.
Yeah.
All constituencies are involved. So we should think about those lines at this stage.
We should. So, Tom, so we've also, you and I have come on air often to try and talk about and wade through this. I mean, yesterday, this was all sparked by their main shareholder saying they will not increase the capital. Then today, he also spoke to another media saying that they don't have any concerns about Credit Suisse. Like, what will the relationship between Credit Suisse and their main shareholders be like going forward, Tom Metcalf?
Yeah, exactly. It was a pretty frantic moment yesterday, and now those comments, they were nuanced, and, to be fair, they shouldn't really have spooked the market as much as they could. Everyone knew there was this sort of 10% kind of cap on what an overseas investor could do. But I think it speaks to, as Jan was just saying, just all the sort of slew of bad news that's been building up about Credit Suisse, and it just seemed to sort of, I guess, break the market sentiment, and you saw what happened yesterday. I think overnight the news has really allowed everyone to take a breath. I mean, look at those shares this morning, up 40%, I think I just saw on the screen. So I think, in terms of those conversations with their shareholders, obviously, I think the communications will be very closely watched for going forward. But, it does now seem everyone is, talking together, moving in the same direction. And certainly this massive intervention, tapping the Swiss National Bank's liquidity thing should sort of allow the markets to look at the fundamentals and fundamentally, Credit Suisse, globally systematically important bank, and it does have, very strong liquidity, very strong ratios, as the statement today was pointing out. And, I think what most people at Credit Suisse, and obviously in the Saudi bank as well, will be hoping that, the market will sort of break this sort of fear-driven move.
Yeah, it's amazing. So let's look at the share price again. At the moment, I think it opens some 40% higher. I don't really know where it stabilizes. I mean, yesterday was down 24%. Jan-Henrik, three concerns. First of all, when do we know what kind of outflows they've seen? So I guess we'll have to wait at least a couple of weeks until we hear from the chief executives, or it could come earlier. And then the other question is, we had an interview with the chief executive 2 days ago. He was clear. He says he doesn't have control of the share price. He has control over the strategy. It's a 3-year strategy. Does the market give him 3 years, or will they be broken off before then?
I mean, to the second question, I think they don't have 3 years. I think it's absolutely outrageous to ask for 3 years. I think the market is very nervous and clients are running the hills or the Alps in the interim. So I feel he doesn't have 3 years. Until then, the share price has collapsed and clients are pulling money in the interim. He spoke about the liquidity coverage ratio. We will see more on that, obviously, with earnings. We don't know anything on flows yet, and probably nobody knows, but I think you can assume that people take this very seriously and people are nervous. Should I pull my money? I mean, there are enough other GSIB banks where I can go to, especially on the deposit sides when we get into the territory of non-insured deposits. So people have a choice here.
Yeah, but and they always have a choice. But let's be clear, on Credit Suisse, right, from what we know, is 1 million miles away from Silicon Valley Bank, right? In terms of the illiquid ratio, for
100%.
example, it can pay back about half of the loans that they have with other banks.
100%. They are much more, their funding is much more diversified. They have a stronger capital ratio. They have more available to sell securities, but we're not in that territory yet. And like Silicon Valley Bank was a special case because it's very concentrated to the tech sector, and that's really not the case here. So yes, they bought time and they have some time now, but let's see what happens next.
Yeah, let's see what happens next. Tom, give me a sense of, this again is a far bigger, more embedded bank than Silicon Valley Bank ever was in the financial system. So at the moment, everything seems fine. If you look at the numbers, they always had access to credit facilities across the world. But if something were to happen with Credit Suisse, how bad would it be for the rest? Is this why we've seen moves across the board in all European stocks, but also, banks around the world?
Yeah, so it's a GSIB, so obviously, the repercussions would be enormous, but I would just counter that, the very fact it is such an important bank should reassure kind of shareholders and people in the market because, like about 30 other banks in the world, Credit Suisse has much higher regulatory requirements. And as you pointed out, it was always able to tap this Swiss National Bank facility. And, I feel like if people drill down into sort of the fundamentals here, there is no kind of immediate sort of fundamental reason why that, there should be sort of kind of this much fear or nervousness around Credit Suisse. And I think you're seeing that in the share price today. But of course, Jan points out, it's all kind of sentiment driven at times, and they just need to break that cycle.
Yeah, they're also looking for an anchor investor, right, to come in for Credit Suisse First Boston. How much is this going to complicate things?
Yeah, that's a great question. I think, let's say we get to the weekend and Credit Suisse is merging with UBS. Let's just speculate. Then I don't think there will be a First Boston spin out.
Sorry, you think, just to make it clear, we did hear but what's the possibility of that? Are we looking 50-50 chance, or is it a 0.5% chance of that happening in that timeline?
I'd go with a 50-50 for sure. I think, and that really depends on what happens in the next days. I mean, the share price is now probably recovered for some time, but it was battered before, right? Massively below book value.
Yeah.
So we'll see that. I think the only, Credit Suisse will say now we continue to execute on the strategy, and the First Boston spin-out is part of that.
Right.
If we get into this discussion of UBS Credit Suisse, I don't think what the point of a spin-out would be.
But so what, 100%? I mean, I didn't know that this was a possibility in that short amount of time. I mean, who would be spurring this? So first of all, would it be orchestrated by regulators and by politicians, or is this UBS who, we know at some point they were talking about a couple of things, saying, look, I buy you wealth management, you get rid of the rest, and that's it, we make a deal?
I think the Swiss government, which is basically the central bank and also FINMA, has an interest in financial stability. Credit Suisse is the second largest bank So you can imagine that they are on top of it. And then, yeah, I think this is now, at this stage, it's driven by regulators.
Yeah, and they wouldn't be too big? I mean, there must be this would be a huge bank, right, if they were to absorb the wealth management.
In terms of assets, it would be a huge bank. You will have to probably consider a scenario where you sell certain parts, maybe you pass them on in Switzerland, not to get concentration to other banks. They will probably sell some wealth businesses, and also, I mean, the investment bank is gone anyway, so that problem is already solved. Yes, they will have to work around the structure.
Tom Metcalf, what was your big takeaway from yesterday? I mean, this, because partly of also what happened in the US, felt very much like a possible 2008 moment. Was it?
No, I think that's probably overstating. It was certainly a moment, and I think what it tells me is just how nervous markets are right now. You've obviously seen Silicon Valley's collapse, Silicon Valley Bank's collapse, I mean. And I think, it just goes to show, you really need to be, everyone's kind of on edge. And so you might see these absolutely, kind of, seems like once in a generation type moves. But yeah, I think when you look at the fundamentals of something like a big bank like Credit Suisse, there are plenty of sort of controls and regulatory things in place to sort of hopefully prevent something like 2008.
Yeah, so if we recap, Tom, what we know so far. So they're going to borrow about 50 billion Swiss francs from the Swiss National Bank. They've offered to buy back some of the senior debt. The main shareholder that almost started this yesterday, today giving another interview to another media, saying, look, the panic is unwarranted. What does it, have they put a floor out of this? Have they managed to, stem the crisis? Certainly the share price, up 27%, seems to suggest this.
Yeah, look, and it was the share price I was looking out for this morning. I think directionally that tells you how the market's going, obviously. And I think, if the share price had fallen, gosh, I think you would have been into another stage of this moment. But I think the actions that got taken overnight, that is pretty gigantic. 50 billion of liquidity like that. And I think they've certainly sort of stalled the immediate kind of fear and concern.
Tom, and to Jan-Henrik as well, if you look at some of these banks, right, and the fact that their revenue model will have to change, either because, Jan-Henrik, they'll have to, for example, increase what they pay depositors just to make sure that they are loyal. There are banks that are much more, much more dependent on interest rate hikes. Is Credit Suisse one of them? It doesn't feel like it in the way that the bank is structured.
Well, every bank is geared towards rates hikes, right? And that's also true for Credit Suisse. I think their model is more based on advisory, generally speaking, right? That's wealth management. In Switzerland, they are, right? It's a deposit-taking bank. So in theory, there's no reason whatsoever that Credit Suisse is not making money in a rising rate environment.
Right, but it was rising interest rates that actually hurt SVB. So can they manage the downside? I think
because they messed up the funding part.
Right, which there are no concerns at Credit Suisse at the moment.
I think that Treasury is better than SVB. And yeah, as I said, much more regulated and diversified. And then, yeah, I think they can access markets quicker. Yeah. And their deposit base, which is the funding, basically, that's how a bank finances itself, is much more diversified.
Tom, I mean, the other question that we had, and I know you and I have been hitting the phones with Jan-Henrik also for the last couple of days, is actually the capital structure and the capital requirements in Europe are different to the US. Can you explain that a little bit? I know there's a sense that actually Europe, a lot of the times, is a mess, but are capital requirements stricter than they are in other parts of the world, especially in the US? And should that give investors comfort for the big European banks?
Yeah, no, absolutely. And look, the key thing here is a reminder that Credit Suisse is a G-SIB, globally systematically important bank, and that just means those requirements are indeed as high as they can be for a bank, effectively. And that is what Credit Suisse has been messaging in its statement. It noted all these things. It's got these strong liquidity coverage. I think something like 150%, which has increased since the end of last year. And I think tellingly for me, there is also a statement in there that basically it's all its interest rate sort of risk. It says it's hedged. So again, very different situation to Silicon Valley Bank, and understandable why that in the same week this happens to Silicon Valley Bank, people are sort of trying to look across to it and see is there much comparison. But I think the only link there is just it sort of injected a lot of fear and turmoil into the market, and that's really been hit in Credit Suisse yesterday.
Jan-Henrik, since David Hare also used to be the biggest shareholder, he pulled out. So the shareholder base for Credit Suisse has changed significantly. So they brought in the Saudi Royal Bank. They were the ones in saying, look, they're not going to put extra money. Maybe now we think it's because of regulatory concerns and nothing else. Today they said, look, everything is fine. Then there's BlackRock, and there's a couple of other big shareholders, including, I think, Qatar. Are we expecting any of them to come out in support of the bank?
If I was a shareholder in that bank, I would do that because it's my money, right? And they lost a lot already. Now, once they're in that, well, once they invested, right, they probably have an interest in a sustainable turnaround. So if I was them, I would probably do that, yes.
Yeah.
But I haven't heard anything.
Yeah, will they? So we are still chasing the phones, Tom, to try and figure out whether that's true. Look, there's something called, we call escape velocity, when you lose control of a situation and actually the narrative is very wrong. What needs to happen, Tom, for a Credit Suisse or something else to have liquidity concerns and interest rate, I guess, risks if you're still fully funded and capitalized? So is it deposits, or is there something else that could happen in 1-2 weeks that could put us back to square one?
I think they'll be coming out and saying, I mean, it actually was interesting, the Credit Suisse CEO sent around a memo effectively saying, look, we need to sort of just be very clear with our clients, the facts, what is going on here. And, they will be pointing to all those sort of liquidity ratios, the fact they do be able to tap the Swiss National Bank. I think, like everything, it's just a reminder just how much, it's a trust business, right, banking, and if you lose that, it doesn't matter who you are, it gets pretty scary, and in Credit Suisse's case, got pretty scary pretty quickly. But, ultimately, if you've got those fundamentals behind you, you sort of got to ride it out, and, yesterday, Credit Suisse shares were absolutely tanking. Today, up, 25% still? So completely different sort of feel on the ground.
Yeah, it certainly is, and it's also dragging up some of the European banks with it. BNP gaining 1.3%, Deutsche Bank 2.3% higher. I know you believe, Jan-Henrik, and we broke that story yesterday, that there's a large possibility. You put it at 50-50. I haven't heard those odds as high from others, that they merge with UBS, or that this Credit Suisse will be broken down and sold off. Would there be any other bidders apart from UBS?
Well, I don't think there are bidders, right, in that sense, but I guess Credit Suisse has very interesting business lines. I mean, the Swiss business is very profitable, and that's, by the way, that has been always the floor, right? 10 billion-ish valuation, or 8-9 billion-ish valuation.
But yesterday it went to 7.
Went to 7, somewhat in that floor. But I guess the Swiss business has always been the floor for the whole bank, and it's profitable and it has been profitable. I think that's one thing that we should note here. With respect to the wealth business, obviously, if that becomes a breakup situation, there will be plenty of assets to sell, i.e. there will be a lot of other bidders, wealth managers, including Julius Baer and so on.
So is there, but this would be what, if it's government orchestrated, do they need to open it to everyone, or are there secret talks about just getting it done, a little bit like what happened with HSBC and SVB UK?
Well, in my mind, it would work like, it would be a full takeover by UBS of Credit Suisse. That would be probably the easiest, and then you figure everything out later. But then it would be UBS's problem, right?
Yeah. Okay, thank you so much, both of you, for joining us, Jan-Henrik Forster and Tom Metcalf. Now, also joining us now is Ven Ram for Bloomberg MLive. Ven, there were a number, of course, of memes going around the internet yesterday with Christine Lagarde, thinking, my gosh, I have Credit Suisse and I have an ECB decision the day after. How many questions do you think she'll field about the stability of the banking sector in Europe today?
Just innumerable, Francine. They've painted themselves into a corner. As you know, last month when they met, they said that they would raise rates 50 basis points this month, and they said it unconditionally. If you read the statement, there is no proviso, there is no rider there saying if extenuating circumstances prevail, we may opt not to do that. They didn't say that, and therefore they've painted themselves into a corner. And today, of course, you've got Credit Suisse issue festering in the background. The big question is whether they will dare go 50 basis points or not.
So, Ven, what are you expecting today? I mean, are they locked into 50? And again, this is very different to what happened to Silicon Valley Bank. This is not really a story about higher interest rates. This is outflows because of mismanagements in the past at the bank. And this is shareholders basically, wondering what happens if their main shareholder says they won't put any more capital in.
Absolutely. I mean, the problems facing Credit Suisse are twofold, basically, at this point. One is the liquidity risk, the other is the counterparty risk. Now, the fact that they've availed themselves of the backstop from S&P to 50 billion franc, to a vast extent, mitigates the liquidity risk. And we've already seen BNP and other financial entities saying, look, we are not going to take counterparty risk where it involves Credit Suisse. But with the liquidity backstop, I think that some of these counterparty risks may start to unwind, i.e. they may start doing business again with Credit Suisse simply because the S&P is on the backstop. It doesn't get better than a big central bank standing behind you. How long is that question, and whether 50 billion is going to be enough is that question. So against that background, Lagarde may think, and the ECB may think, hey, look, having committed to 50 basis points, and it's a very different backdrop, as you said, to Silicon Valley Bank, therefore, they may feel emboldened to go with a rate hike, albeit whether it'll be 50 basis points, we need to see.
Ven, if they knew anything less than 50 basis points, is there a capitulation or saying, look, there's something wrong with the banking system? Is it? I mean, this is a double-edged sword. The ECB president has to walk a very fine line.
Absolutely, the communication is going to be crucial here. As you said, if they don't do a rate hike, it will be seen as a cop-out by the markets, and the markets will think, hang on, does the ECB know something that we don't? And that may perpetuate a negative feedback loop. And I think they are aware of that. But if they go 50 basis points, then what does it mean for liquidity at this point? I mean, it must be said that there is no systemic distress at this point. I mean, if you look at the markets, the classic money market markers, there doesn't seem to be that much panic, as you said, as was the case with Silicon Valley Bank. And everyone knows that this is a globally, systemically important bank, that they are crucial to the financial framework, but they are adequately capitalized. The crisis is one of liquidity and confidence, and the S&B's liquidity backstop, to a very large extent, addresses that thing. So I do think that the ECB may think, you know what, maybe we should go through with what we plan to do.
Ven, thank you so much. As always, Ven Ram there from Bloomberg MLive. Now let's also bring in Peter Han, Emeritus Professor at the London Institute of Banking and Finance. Peter, thank you for joining us. I mean, it's pretty incredible what we lived through yesterday with Credit Suisse, and I guess it raises the risk of a bank lending crunch that could tip economies into recession. What do you see as most vulnerable in the banking system today?
Well, I think the Swiss National Bank has served the purpose of getting some stabilizing effect for the moment. The question is whether the market accepts that Credit Suisse's problems have been stabilized at the moment, or this is just a sticking plaster for a problem that's just going to continue. One of the big issues that this brings up is some regulatory unintended consequences, you might call it. And we saw these a bit with Deutsche Bank a few years ago. So Credit Suisse's shares fell. When its shares fell, its bail-in bonds fell in value. If you were an investor in those bail-in bonds, which are generally illiquid, the way to hedge that would have been to short the shares. And so as the share price falls, you usually see people shorting it. You encouraged even more towards. If you were a market player, you would have joined in probably and shorted even more. So it becomes a bit of a death spiral. So today, that stabilizing effect should stop that, and we'll see where the market takes us.
Peter, what are you watching out for more immediately in the next couple of days? So we need to know about the outflows, right, what clients are behaving. We're also getting a couple of memos saying, for example, that they're losing talent to APAC Equities co-head. They're also losing some of the other. We don't know whether this is linked to what happened yesterday, whether this is an acceleration or it's just a general attrition post-bonus season.
Okay. With Credit Suisse, I think if I were an investment banker at Credit Suisse, I'd really question the future of the institution. Is there going to be the money to invest in the business? So if you're a money spinner at Credit Suisse, if you haven't been looking, you are looking. And there isn't enough of an upside to keep you there. If you're a client of Credit Suisse, you really want to say, are they going to invest in my business? What's going to be there? So if you're a better client, you're reviewing that. If you're, so from a Credit Suisse standpoint, you'd almost say that what the government in Switzerland needs to consider is the bank going to continue to weaken? And do they take a step further than liquidity support, in a sense, an equity support or some type of almost investment nationalization to stabilize it, to keep clients in? Or do you think this will be enough? If I look at the marketplace, yes, the marketplace traditionally looks, well, who else is the next weakest player in the market? There isn't an obvious one really in Europe that sits there. So I think this is less of a European banking issue than it's been made out to be.
But Peter, what happened then? I understand, I mean, the largest shareholder says, look, we're at 10%, we don't want to do more, and the share price tanks by 24%. CDSs blow up. Like, was it overreaction? Was there panic? Like, how do you explain what happened yesterday?
Well, what happened, I think that point about a spiral, so all of a sudden it becomes quite clear who is going to put equity into this bank, right? You've got the major investors, the largest investors sold out recently, the largest long-term investor as well, sold out. The recent ones came in and said, we're not going to put any more money in. So is someone going to jump in who's, hasn't had exposure to this bank and try to catch a falling knife? I doubt it. So the market gets that acceptance, says, okay, what are we going to do? And all of a sudden, the potential for those bonds, which are there for recovery purposes, to be converted, starts to become more real. And that created this spiral, if you will, that pushed the share price down even more. So we look at the moment like it's stabilized. But I guess the question really is, does somebody look back and say, do we still have this same problem that, Credit Suisse is going to be a business that doesn't do better?
But so, Peter, so the question is, first of all, does Switzerland really need two big banks? If one is almost on its knees, where we've seen, billions of outflows from clients, and maybe the market doesn't want to give them a 3-year turnaround plan chance?
Yeah. No, I think if I took the point of view of, a Swiss taxpayer, I look at this and say, I think the sooner the Swiss National Bank actually takes a greater control role over this institution, the less it's going to cost them. Because the longer it waits to decide, there'll be more and more costs and going in. So your question about does it need two large banks?
Yeah.
Well, you know what? You could break this up into a Swiss bank and then deal with the other parts. And I think that might be better done privately than in public.
Right.
So to me, you can have a Swiss second large bank and have the rest in liquidation of some sort that's overselling.
Peter, so do you see a UBS, Credit Suisse merger for the wealth management, and do you see that happening in a short, in short timeline actually?
That would be, I think, a very wise strategy for the Swiss government, Swiss National Bank, to look at how do you create sort of one large wealth institution, and think about how you wind down out of the investment banking business, and then have a strong domestic commercial bank in there to compete with UBS's commercial banking business in Switzerland, providing credit to Swiss businesses.
Peter, thank you so much. Peter Handler, Emeritus Professor at the London Institute of Banking and Finance. Meanwhile, against all of this market turbulence, the European Central Bank also makes its latest monetary policy decision later today. Joining us now is Bloomberg's Maria Tadeo, who's in Frankfurt. It's very clear, Maria, that the big ECB hike is now called into doubt by what happened with Credit Suisse. What can we expect?
Yes, Francine, and what a roller coaster this has been, because if you go back just a week ago, this was almost an autopilot situation. European Central Bank is going to hike 50 basis points. That was very well calibrated. Core inflation sticky. You got to tackle that aggressively. Then, of course, enter this banking chaos that we've seen play out over the past 72 hours, obviously amplified by Credit Suisse. And there is an important line by Madame Lagarde in the previous meeting where she said in the press conference, she predicted and guided to this 50 basis points unless something extreme happened. Now, the question yesterday was, is Credit Suisse extreme enough to run that 25 basis points hike today? Now, Francine, the news flow has been very intense. Now you see the Swiss intervention, the market now moving on the positive side, and now those that believe there should be a 50 basis point hike, they'll tell you the ECB then therefore needs to look past the market volatility, look at that data, and that 50 basis points hike is warranted today. But that debate is alive. And Francine, in so many ways, what a day for Christine Lagarde to have to make a decision like this of this caliber.
Yes, although, I mean, on the plus side, actually, she can say something meaningful in the banking sector. They regulate it. So what are we expecting her to say on that?
Absolutely, Francine, and that is going to be a key point in that press conference. Beyond the monetary policy decision, whatever way it falls, that is going to be a key point. For the time being, we've not really had any communications from the European Central Bank for a number of reasons. We know that they do not comment on specific stock moves. We also know it's a quiet period, and also yesterday there were deliberations going on. But we also know there were many reports that the European Central Bank had reached out to European banks to figure out what kind of exposure they had to Credit Suisse. We also know that the French Finance Minister, Bruno Le Maire, was on the phone with his Swiss counterpart, also trying to figure out that situation. But in terms of the communication today, Francine, this is a message that you have to hear, not from a politician, not from a finance minister, but the head of the central bank. She needs to be able to deliver and instill this confidence in the market. So the language, communications today is going to be very important, incredibly important press conference by Madame Lagarde.
Yeah, absolutely. Maria, thanks so much. Maria Tadeo there in Frankfurt. Credit Suisse default swaps are tightening, shares are surging. That's the very latest, but of course there's still so many unresolved questions about regional banks also in the U.S. Now we'll bring you live coverage and analysis of the ECB rate decision and the news conference a little bit later today. The picture for the markets overall, a little bit still fragility. So we did have last night's statement focused on liquidity for Credit Suisse. Good, because investors needed that certainty on that front. So we're seeing a bit of a bounce back, certainly for banks. Credit Suisse was flying at the open, up 40%. Now it's gaining some 27%. The picture overall for markets is a little bit one of relief, but they haven't regained some of the losses that they had all week. So European stocks in general are gaining after this, measure of calm for jittery investors from the regulators, from the Swiss National Bank, and from Credit Suisse itself. The Treasury 10-year yields edging higher following some steep declines in the previous session. I'm also looking at bonds across Europe gaining, the German 10-year yield up 10 basis points, and actually an index of the dollar is falling. Let's go back to Zurich and let's bring in Bloomberg's Oliver Crook, who's on the ground. Ollie, what's the latest there? So we keep on having messages of support from the regulator, from the Swiss National Bank, even Credit Suisse saying, look, they will buy back some of the bonds to stabilize the markets. But we're also hearing about departures from the bank. What are you looking out for?
Yeah, Francine, I mean, it's been an incredible 24 hours. And really, the share slide yesterday that we saw and the bounce today really speaks to the volatility of the story and how much of it is sentiment driven. So you had the Swiss authorities, speaking with Credit Suisse late last night. Somebody had to say something. We got that statement at about 2 in the morning, 50 billion francs to really stem the bleed. And I think that there was a lot of question this morning about whether or not it would work. And as you can see in the market, at least from the share price, it's erased most of the losses from yesterday. So there is kind of the market, which has really served as the kind of the main problem here, has seemed to have bounced back. And and it's not often that the Swiss and the Bloomberg headlines are the same. Here you had it across plastered across here. Credit Suisse is in crisis. The National Bank throws a lifeline that, as far as this point, seems to be having its intended effect.
Yeah, and again, just to everyone, last night's statement focused on liquidity, which is good because investors really needed certainty on that front, and that should also put a floor for now on some of the questions and concerns from some of the other banks. What do you think happens next, Ollie? Certainly when it comes to, I know you're where it's happening. Chief executives are probably running to and from headquarters.
Yeah, I mean, so this has been an almost exclusively sentiment-driven story. There was not a huge amount of news yesterday that precipitated this. It was the news from the other SMB, the Saudi National Bank, saying that they wouldn't put more liquidity in, but any more investment in. But anyone who had been following the story knows that they didn't want to cross that 10% threshold of ownership because of the regulatory concerns. So that was really the main thing that instigated this whole thing. And again, the market has been the judge, jury, and executioner throughout this entire time. 24 hours makes all the difference. It went from a bank in trouble to a banking crisis, now trying to get back to a bank just in trouble. And looking forward, all of this, though nothing has changed really materially at the bank in terms of their strategy, and we heard a lot of the same sentiment from the CEO that we've heard for the last 3 weeks last night. This cannot be good for morale. This cannot be good for retaining and attracting talent. And this is only going to make the process of turning this bank around a lot harder.
We're also having a couple of breaking news. I mean, of course, this is the only thing everyone's talking about. So Jeremy Hunt, the Chancellor of the Exchequer here in the UK, who also delivered his budget yesterday, was asked on Sky News whether he was worried about the risk of contagion from Credit Suisse to UK banks. And he answered that he was encouraged by Switzerland's liquidity support. If anything, Ollie, actually, Switzerland authorities, regulators, and policymakers acted swiftly.
Yeah, they certainly did, and it's been a major concern. We talk about the global systemic importance of Credit Suisse. Obviously, that is what's in focus for global markets and why we saw the broader, European banking market sell off yesterday. But it's very, very vital to this nation, Switzerland. This has retail banking, this has commercial banking, and when you speak to people on the street here today and just get a sense of kind of how they feel about this, there's a lot of head shaking. There's some jokes going around that you can buy, a coffee for a couple of Credit Suisse shares, but you also have other people on the other side. I spoke to somebody who said he bought 50,000 Credit Suisse shares yesterday, and if that's true, he's done fairly well for himself. I spoke to somebody else who said that they actually pulled all of their money out of Credit Suisse back in October. So again, this is also a very emotional and a very critical issue here in Switzerland.
Yeah, the share price actually was halted on the upside for Credit Suisse. It's now gaining some 23.7%. Speaking to a couple of market participants, they say, of course, the question is whether the strong gains in Credit Suisse can be sustained. And some are also suggesting that, look, it could be driven by investors covering short positions, and such moves could fade very fast. So, Ollie, thanks so much. Oliver Kirk there in Zurich with the very latest on Credit Suisse. Let's also get to Philip Richards from the European banking team at Bloomberg Intelligence. Philip, when you look at the 50 billion franc liquidity backstop and, the bet buyback, this eases fear, but for how long?
Yeah, good morning. I mean, this is exactly what the market needed, the reassurance coming from the Swiss National Bank saying they are behind Credit Suisse and they'll do what they can. But just noting the comments there, as we're talking about the shares rallying back again, but if you look at the bigger European banks, they were down 10% or more yesterday. I mean, in a number of occasions, and they're only up 2, 3 or 4% so far today. And if you look over a week's view, they're still down 10 to 20%. So yes, this is a big relief, and it's given some confidence back. But clearly, we're nowhere near back to where we were just a week ago.
Do you have concerns about the solvency, the liquidity at Credit Suisse? I know they acted swiftly, but was there a need to intervene because something was not right in there?
Yeah, well, there's 2 points there. And first of all, were we, people comfortable on the capital and liquidity position of Credit Suisse? I think absolutely. I mean, it's got a very strong capital ratio at 14.1%, and also a strong liquidity ratio. The point is, this is not about looking at fundamentals and long-term positions of the bank. This is about short-term deposit flows and about confidence in the sector. And the fact is, we've gone through so many reforms over the last 14 years since the crisis. We thought this was all in the past now, these bank runs. We've got much stronger regulation, capital, liquidity, and yet we're still back in the same situation where, banks can face it over, not really much news.
And we understand that policymakers are looking at all options, including a breakup of the bank, a possible absorption with UBS. Do you think this makes sense? Does it become then too large and too systemic if they put the wealth management business of Credit Suisse with UBS? Or is this the right way that actually should happen quite soon?
I don't think there's any panic, and we need to do this quite soon. I mean, these are big issues, and Credit Suisse has been going on doing a restructuring for many years now, 4 or 5 years, and it's an ongoing. They're looking at selling off parts of the investment bank. So these processes will continue. What's the final goal? But at the end of the day, Switzerland may actually want to still keep its 2 big banks, but sometimes if you're reliant on just one bank in the market, that can cause its own problems as well. So I think this is not the time to look at restructuring, breaking up the bank at this stage. I think it's much more a case about getting that confidence back and then basically taking stock and trying to get more of a long-term view.
All right, Philip, thanks so much. Philip Richards there from Bloomberg Intelligence. Let's also get back to Ven Ram, of course, the implications for the ECB rate decision a little bit later on. Ven, when you look at the banking system, when you look at what kind of interest rates they need, because this was a panic that wasn't actually really caused by any underlying issues that had to do with higher interest rates, increases at the ECB and what that means for funding for banks, how do you expect Christine Lagarde to navigate this?
I think Lagarde and the Council will be concerned by what it means, the short-term implications of the crisis. I mean, the markets are kind of back, seem to be regaining some of the poise, but as we said, this could be simply because of short covering. But if you look at the German bonds, that is a saner market, and you see that yields are backing up today. And that should give Lagarde and the Governing Council a lot of confidence that, look, the markets seem to be adjusting themselves pretty well and pretty quickly at reacting pretty quickly to whatever is coming out of Switzerland. And therefore, I think that they may think that, okay, look, this is a well-telegraphed rate path that we've been on. Inflation is still a problem. There doesn't seem to be any systemic issue at this point. So I think that those are the challenges that Lagarde will be passing this afternoon.
So confidence is regaining, but overall confidence seems still pretty fragile then. Does Christine Lagarde, the ECB, need to do some kind of credit facility? Do they need to open to reassure the markets for whatever comes next? If it's not Credit Suisse, someone else?
Absolutely, and I think that's a great question, because I do think that there is a chance that they will go more than what the Swiss National Bank has offered to Credit Suisse by opening a credit facility or a discount window. It is eminently possible, and even if we don't get an announcement immediately today with the statement, one may follow over the weekend or even early next week, depending on how the situation with Credit Suisse plays out.
But then again, the capital ratios needed, the way that actually the banks are structured in Europe are different from the US. Do you think that the ECB, but also governments, need to step in and actually do what Treasury did in the US and say, like, look, we're the ultimate backstop, we guarantee all deposits? Or do we have mechanisms that can give stability without going that far?
Well, I don't think they need to go that far, because what happened with Silicon Valley Bank is very different from what is happening with Credit Suisse. Credit Suisse is very well capitalized, is a globally systemically important bank, whereas Silicon Valley Bank didn't really come under the Frank-Dodd Act, and therefore they had issues with the balance sheet, and they were not really prepared for what the Fed was doing in terms of raising rates, and they had a asset liability mismatch, because their swaps simply weren't enough to hedge the interest rate increases that were coming. That is not the case with Credit Suisse. What Credit Suisse is facing is a crisis of liquidity, where especially yesterday, when we saw BNP saying that, look, we are not going to take counterparty risk with Credit Suisse. Now, that is pretty sinister for a bank. I mean, if you lose trust and if counterparties do not transact with you, regardless of how well capitalized you are, the game can be up. And we have seen that happen during the financial crisis. And therefore, what we were looking at yesterday was a very real threat to the systemic equation in Europe. But as you said, with the central bank standing behind Credit Suisse now, that changes the equation a whole lot. It definitely buys them time over the short term, and they will hope that will work for now.
And then I 100% understand this, but even before all of these extra facilities, look, Credit Suisse had many, many problems. They had to deal with huge outflows, but they had healthy levels of liquid assets should they need it. They had access already to facilities across the world, the world, with a string of central bank facilities in multiple countries. So if you look at the next big risk for Europe, if it's not Credit Suisse, could it come in shadow banking? Is there something that we should worry about that the ECB is now game theorying, which they weren't thinking about 3 months ago?
Probably there's a lot of that shadow banking. There's probably a lot of that in crypto assets as well. And those are the areas of the markets that are pretty vulnerable, because they are less regulated. Few people understand them. Even fewer people kind of were invested in them and invested knowingly in them. So there's a lot of speculation and froth in that market, and there could be some vulnerability there, and that's what I think the ECB would be worried next, not these well-regulated banks.
So then let's try and game theory of our own. Let's say there's a 25 basis point hike from the ECB today. What happens to yields? What happens to markets?
I think it will tell the markets that, look, the ECB is still preoccupied with rate tightening. I think the markets may initially the bonds may rally a bit because 25 basis points isn't what they promised. They may rally a bit, but as the dust settles tomorrow and subsequently, yields will still keep going higher, especially if the Credit Suisse backstop seems to be working.
Ven, thank you so much, as always, for your great insight. Ven Ram there from our Live team. Now let's stay on Credit Suisse, bring in Paul Davies from Bloomberg Opinion. Paul, thank you so much for making it in. I loved your story yesterday, and really, it's a wonderful read for everyone. It's often when you're most in need that you find you have the fewest friends. Who are Credit Suisse's friends right now?
Who are Credit Suisse's friends right now? Well, the SNB this morning, most. And
the regulator?
And the regulator as well, exactly, yeah. So they've come in last night with this extra liquidity facility, which will allow Credit Suisse to sort of use a bunch of assets that they wouldn't have been able to use otherwise to source liquidity should they need it. I mean, they have plenty of cash and plenty of other kind of liquid bonds on their balance sheet, as we wrote about yesterday. This is kind of really an extra kind of, it's a belt and braces thing, really, I think, as much as anything else. But it should, answer any kind of questions that anybody might have about whether it could, meet deposit withdrawals.
And you were at pains at explaining, and actually, if you look at the numbers, I mean, this was not a bank in a bad shape. They have huge problems, outflows. They can't really get ahead of some of the scandals. They can't really get ahead of, some of the things that they came out. Yeah. But they were adequately capitalized. They had enough liquid assets. So what happens next, actually, to the bank?
So what happens next to the bank? Well, I mean, I guess they've still got kind of longer-term, sort of more chronic problems that they need to deal with in terms of sorting out their restructuring and getting the market to believe in their strategy. One of the things that will need to happen is they'll need to give a lot more detail around how the set of businesses that they're going to turn into, how they're going to look, what the cost bases are going to be like, what the revenue run rates are going to be like. These are some of the key missing pieces that analysts and investors still can't quite get, and they can't quite get an understanding of what the business is going to look like. And that's really important for where they are in the market, and that's kind of part of the reason why I think they've struggled to find investor support in the stock market during these kind of febrile, slightly kind of panicky times.
So can they survive alone, or at this point we hear that there's options on the table, that regulators, that policymakers are looking at a potential breakup of the bank?
Right. I mean, in the immediate term, they absolutely can survive. There is no reason for any kind of real problem to surface in a matter of days or weeks. There is no kind of acute crisis here. The longer term is a much more tricky thing where, as I say, they still need to answer a bunch of questions about what the business is going to look like. And the problem when you get into a situation like this, when your share price falls, when your debt drops in value and the cost of insuring it against default, really soars, that affects the costs of doing business for an investment bank. That's why we saw some of these derivative counterparties yesterday talking about wanting to reduce or not increase their exposure to Credit Suisse. And that kind of affects, again, the sort of the revenue and the profitability of the business. And as a long-term issue, that's something that really needs to be solved, because otherwise, it will be in a trickier situation.
What did you learn yesterday? So I couldn't believe that this happened so quickly, right? So you had the Saudi, the Royal Bank basically saying that they won't put more money in this because of regulatory concerns, right? They didn't want to really go above 10%, and the market freaked out. Were you surprised by the pace at which this happened, or actually on how fast it was dealt with?
Well, I mean, yes and no. I mean, it came as a surprise as it happened. I was thinking of writing about Credit Suisse anyway, because we know that there is issues to look at, and we know that there was a lot of tension in markets in general in terms of worries about banks and particular.
Well, because they had a record low the day before.
They had a record low the day before. They had several record lows over the past 6 months, and they've had a string of issues to deal with. I mean, I think that when markets are in such sort of tense moments, everybody is looking for the next thing to break, or I mean, also they're just looking for good hedges. If you want to protect yourself against any of your other investments losing value, you look around for things that you think will definitely struggle in these times, and then you put your hedges on against them. So, you know, if you own another big European bank that you're not sure how well it works, and you're looking for a hedge against that, you know, Credit Suisse is an obvious thing to short, or their CDS is an obvious thing to buy because you think they're going to move anyway, right?
So, Paul, your word of wisdom in this you know, very fearful market in general is what? Tread carefully with banks, or
is well. As an investor, as a shareholder, definitely tread carefully. But I mean, I think that we're in a moment where, you know, a lot of things are very undervalued, and, you know, when this moment passes, assuming that this moment does pass, we will see a lot of rebound in a lot of stocks. I mean, Credit Suisse itself is up 40% this morning, I think, the last time I looked. As a depositor, you know, there is a huge amount of liquidity out there and available. So
yeah, and so we have the ECB later. We'll see what they have to say about banking facilities. The share price of Credit Suisse halted again on the upside. Very quickly, when do we find about outflows? I mean, if they have a huge outflows, this is going to be problematic for Credit Suisse.
So, I mean, they're not going to update, you know, every week. They're due to report their first quarter, I think, towards the end of April.
Yep.
I think before then, we might well get some other updates around the AGM, you know, the shareholder meeting, which is going to be in early April. So we might have an update then. Yep. Ulrich Körner, the CEO, gave a bit of an update at the start of this week before, it seems like a lifetime ago already, but before this madness happened.
He was on this very set.
Exactly.
It does feel like a lifetime ago.
So, you know, I mean, unless the SNB gives them some kind of, you know, instruction that they need to update immediately, I don't think they need to necessarily say anything until, you know, the end of the month, start of April. Yeah.
Paul, thank you so much, as always. Paul Davies there from Bloomberg Opinion. Now let's also bring in Bloomberg's Ollie Crook, who's in Zurich. Ollie, you're in Zurich. I imagine this is what people are really talking about. What's the mood like?
Absolutely, Francine. I mean, you have people coming by. We have a big setup here with lights and camera, and some people are intrigued, and so we talk to them about kind of what their sentiment is here. We talk about the global importance of this bank, the systemically important factor that this bank has. In Switzerland, it's absolutely critical. They have retail banking, they have commercial banking. A lot of the money, the capital that flows through this country goes through Credit Suisse. And so, you know, you speak to some of the people, they sort of shake their heads. They say, oh, you know, this is, you know, they feel bad for the thousands of employees that the bank has. There's a joke that, you know, you could buy a coffee for a couple of Credit Suisse shares. But then on the other side of it, you have people that are actually quite bullish on the bank. We spoke to one person who said he bought 50,000 shares yesterday. If that's true, I asked, you know, do you happen to work for Credit Suisse? He said, no, you know, he was a wealth manager, and he did it out of his own pocket. And then, you know, I spoke to somebody else who also said that they withdrawn all of their money from Credit Suisse back in October, and they know other people have done the same. So again, this is an icon for Switzerland. This is an icon for global banking, but really here it hits home.
Yeah, we're also getting some banking notes. So I would note Mohit Kumar from Jefferies saying, look, we should stress that the ongoing concerns over Credit Suisse are an issue of liquidity and profitability, not of solvency. However, without a regulatory backing and liquidity line, a liquidity issue can transform into solvency issues. Ollie, I have to say policymakers in Switzerland moved fast.
That's right, and they identified the problem, which was really not driven, as we've been highlighting, by any real news. Basically, it's been something that's been, the market has forced, right? 30% down on the shares, CDS is skyrocketing, debt going into distressed territory. That is what precipitated this for the SNB to bring out that bazooka, which is a measure they have not used for a major Swiss bank since the 2008 crisis. So this is not the situation we're in now, but that is the measure that was required in order to reverse the sentiment on this morning, and hopefully for Credit Suisse that will hold throughout the day and indeed the coming weeks.
Oliver, thanks so much. Bloomberg's Oliver Crook there in Zurich. Just a little recap of what we know so far. Credit Suisse will borrow up to 50 billion francs from the Swiss National Bank. The lender has also offered to buy back some of the senior debt. The shareholder, Saudi National Bank, that really started this yesterday by saying that they will not put any more money into the bank, now saying that the panic is unwarranted. Analysts and investors have paired bets for half a point ECB hike. And then when you look at Credit Suisse, the share price is gaining 23%. I have to say, keeps on being halted because of volatility, but it has been surging the most on record at the open, and default swaps are tightening. We don't know how long it lasts, but for the moment, we are seeing a little bit of stability across the board for European banks. This is Bloomberg.
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight, because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while up. This is a 3.
As the economic picture down.
The OK is getting ready to make.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
The problem is that Credit Suisse, by some standards, might be too big to fail, but also too big to be saved.
This stock has been in a huge downfall for 2 years. So there are clearly problems within this particular institution.
We simply don't know the degree to which this is systemic or isolated.
This is a global bank. There might be counterparty risk for some of the U.S. banks.
If one gets into trouble, people very quickly start looking, oh, what's the next one that looks remotely like this?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a moment overnight. 1:45 a.m. Zurich time, that statement dropped. Credit Suisse tapping the Swiss National Bank for as much as 50 billion Swiss francs. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance, starting just a little bit earlier on a busy day for you. Equity futures totally unchanged on the S&P 500. Credit Suisse stock anything but unchanged. Tom, that stock is up by about 20%.
I think it's wrong here. It's not up here. It's the first print, the first enthusiasm off the SMB News, and now where is it? It's down 13% from the opening move an hour or so ago. So we had the surge, John, and now we're coming down in a measured and orderly manner, and we'll see where we set out through the morning.
The top shareholder of the Saudi National Bank caught up with CNBC a little bit earlier this morning. Everything's fine now. Everything's fine. Just to be clear, they've cleared that up. I'll share the quote with you. It's panic, a little bit of panic, I believe completely unwarranted, whether it be for Credit Suisse or for the entire market, after his comments to Bloomberg yesterday when he was asked if he'd provide more assistance if needed. 2 words. Absolutely not.
Honestly, what kind of phone calls were behind this walk back? That's my question. And what was the conversation with the CEO of Credit Suisse and the chair of the Saudi National Bank after that conversation? I wonder if they said to him, look, you better get out there. You better do something soon. And his own shareholders were saying, really? This is a huge part of our investments. What are we doing? The
sequence of events yesterday was amazing. You just watched the reporting from the team here at Bloomberg, elsewhere at the Journal, the FT. The FT came out with a report yesterday that Credit Suisse was asking, almost pleading with the Swiss regulator, the Swiss National Bank, to come out and have a public show of support. And we finally got that statement, Tom, late into the afternoon here in the United States.
No, we got the statement there, and we'll go over that with the ramifications of it, what it means for the accounting statements and profitability and future of this beleaguered bank. But to me, the most important phone call, I think it's speculation, but it's in the zeitgeist with the ECB meeting today. 1-800-Paris. Hi, incoming, Mr. Macron. Hello.
Yeah.
Because BNP Paribas is not Credit Suisse, and SocGen is not Credit Suisse, and you wonder what the French government said to various parties in the last 24 hours.
And you also wonder how that governing council meeting went at the European Central Bank. That concludes this morning. At least we will get a decision a little bit later. I mean, talk about a rock and a hard place for the ECB after pre-committing to 50 basis points, essentially. What are they going to do?
I honestly have no clue. I think that nobody has a clue. Jim Reed over at Deutsche Bank puts it out really well, saying, yesterday was a day to look at the screens and really wonder what, as a research analyst, you can really say that helps anyone. You are not privy to the conversations behind closed doors. And frankly, I think that that is very valid at a time when, what can they say? If they're damned if they do. If they don't raise rates, are they saying that the financial system is that fragile and they're edifying some of the concerns?
I want to just say one thing here before we get to our wonderful set of guests today. And let me tell you, folks, the guests right now, a lot of people can't talk. Their lawyers are saying, you're not going to go on with John Farrell. Bramo, you will not speak to Lisa Abramowitz.
A lot of people say that, but it's
for good reason.
For
good reason. But I want to make clear here, just in 30 seconds, that there is one thing about a balance sheet liquidity cover, and we'll talk about that into the 4 hours today, but what's far, far more important here is this is still a profitability question, and wealth management is a going concern, and that was not addressed in the last 24 hours.
Not at all, and so I might go a step further as well. You don't get those kind of statements at 1:45 in the morning, TK, these kind of moves from banks when things are good. Things aren't great right now.
We're not going to do too much of this, but I got a huge response yesterday, the tick by tick. John, the 10-minute interval just broke down on Credit Suisse ever so slightly. We're not back to where we were yesterday, but it's a chart looking for a bid right now.
Well, it was halted, so I believe it's resumed trading. So we are a little bit higher, but way off session highs. We're higher now by 19% on Credit Suisse. The fact is, we've just about reclaimed a two-handle on the name. So we'll keep an eye on that for you. Here's the broader market at the moment. Equity futures unchanged on the S&P 500. I have to say, if you looked at the equity market yesterday, you would have no idea whatsoever what has been happening in this bond market. Your 10-year, 349, yields up by 3 or 4 basis points. That's like nothing compared to what we've seen recently. The 2-year up by 10 or 11 basis points, but still, Lisa, still sub 4% at 399 on a 2-year at the moment. This is a fascinating moment, not just for the ECB, but also for Chair Powell next week.
The last time we saw this amount of implied volatility in Treasury yields was December 2008, just to give you a size and scope in terms of what we are talking about in volatility. What we're watching today is Credit Suisse, tick by tick. We are going to just be watching those shares, not just Credit Suisse, but also, Tom, as you mentioned, BNP, SocGen, the European banking complex, which at one point yesterday saw the biggest decline going back to the height of the pandemic in March 2020. How much do we see a revival in confidence? Because right now, yes, you're seeing a bit of buying, but it is not exactly a ringing endorsement of stability. At 9:15 a.m., what does Christine Lagarde do? Honestly, comes out with a statement. How do we deal with a situation where there clearly is fragility, at least in sentiment, where they want to give sense that there is a sense of stability, and they are facing an inflation problem? This is just a quagmire to me.
Doesn't the bank move tell you that central bank policy has started to bite? And if it does, is it a mistake to isolate the banking issues from the monetary policy decision? Because the conversation we're ultimately having here is we're asking a question, do they have the tools to insulate certain banks from the rest of the financial system to allow them to carry on hiking? But isn't there a signal coming from the banking system that says, well, the hiking's working?
Well, and Tom, to your point, you've been watching the Bloomberg Financial Conditions Index religiously, and you have seen an incredible tightening over the past couple of sessions.
Well,
so to that point that John's making, it's already being reflected in market activity.
Let me sell the morning for you. Joining us will be the gentleman of super restrictive, Dominic Constable, join us, a former employee of Credit Suisse, and the vice chairman, Richard Clarda, will join us about that partition of monetary policy and bank supervision.
Just real quickly, this is quite a day to be testifying about President Biden's budget. U.S. Treasury Secretary Janet Yellen is testifying today before the Senate Finance Committee. It had been about the budget.
Conflating a budget discussion with this bank crisis? I've never heard of that, John.
How dare you?
All right, that was supposed to be the conversation. Instead, it will be about banking stability.
Should we have a budget special with Janet Yellen?
What happens with that?
You'd like to do a budget special at 10
a.m.
Eastern time.
Budget special with Janet Yellen.
Let's try and get through the next couple of hours if we can. We'll do that with James Athey this morning, investment director at Aberdeen. James, these moves in the bond market, and good morning to you, sir. Your 2-year yield over the last few sessions, I'm talking 20 basis points lower Thursday, 28 basis points lower Friday, Monday down 61 basis points, Tuesday up 27, yesterday down 36. What on earth is that?
That's volatility, John. Good morning, by the way. I was very much enjoying the conversation you guys are having there. That sounds like the voices inside my head over the last 48 hours, really, just trying to piece it all together. Yeah, incredible volatility. I think, again, the timing is critical here. What we've just seen in terms of banking system in the US and then subsequently fears about banks over here in Europe came hot on the heels of the Federal Reserve having opened up the right tail on rates again, opening the door to 50 basis point hikes off the basis of justifiable data, but largely very lagging data, which I think is my major concern about such a move. You had that, and within days we had problems in the US banking system, and so we really did aggressively move from one side of the boat to the other. And over the last 2 years, what have been the big consensus trades? Really, it has been flatteners, it has been shorts, it has been steepness in the strip, all of the things which have been utterly crushed in this move. So I think positioning sentiment and market structure, the role that CTAs we know play in some of these volatile and violent moves. CTAs would have been short at the start of this process, and so they will have been covering and probably going long. So I think it's a confluence of events that gives you that sort of vol.
James, I know it's inappropriate for you to speak within an executive capability of Aberdeen Asset Management, but I do want to focus on your years of work in asset management, where we have seen a crushing battle for profitability. I want you to give us a picture of Credit Suisse with money flowing out, and they've got to make X number of beeps in bond management. They've got to make Y number of beeps in equity management. In the old days, you made 2%. Those days are gone. Can you perceive that any major beleaguered bank can be profitable in asset management given these events?
Yeah, I mean, this is a long process, Tom, going back 20 years. I started my career at the asset management arm of Deutsche Bank, and in the middle 2000s, certainly the London business there was deemed really not to be core. It was making a 8 or 9% return on equity at a time where the bank was making 25%. You roll the clock forward 5 years, and obviously that calculus had completely reversed, because it turned out those sort of high return on equities for investment banks were utterly unsustainable. We've reached a kind of latter phase of this process now, because competition and the role of passive investments has really pressured marginal fees lower. And to some degree, the asset management industry is kind of overbroked. You have a huge number of asset managers, and that's, I think, why we've started to see mergers and acquisitions in recent years as people try and find scale just to get that profitability. But potentially the market environment has informed some of that as well. I've long believed that while passive investments absolutely play a role and do offer an attractive option for a lot of investor styles, the idea that you can just passively lock up beta and make money over long periods really is a function of this kind of monetary easing zeitgeist where everything has rallied so long. You go back to periods in history where there have been greater challenges, shall we say, and you get long periods where equity beta, for example, goes nowhere. So I do think there is an evolution, and things will continue to evolve. But you're absolutely right to say that Credit Suisse has had problems from both sides, making money in asset management in a competitive arena, but obviously problems on the investment banking side and the investment banking model as well. And I think that's why their focus is trying to shift back to what they've traditionally been good at, which is very much the wealth management side.
Just quickly, shifting back to the profitability of actively managing a fund right now amid a morass of uncertainty pretty much everywhere. What do you do? I mean, this has been actually probably pretty good for you, James, because you've been conservatively positioned and in safer assets. Do you cash out and go full risk, or do you just hunker down and wait for something to happen?
You've probably been speaking to me long enough to know, Lisa, that it takes a little bit more than a day's relief to get me fully into risk. And actually, I had your voice in my head over the last couple of days thinking about
That's never good, James.
Describing me as being conservatively positioned. But yeah, we've been long and in steepness, and so the moves have been largely in the direction that we've been expecting. I don't sort of expect... Authorities have taken steps, and they've taken them quickly, and that generally, at least it temporarily draws a line under these sorts of events. It does look to me to be largely solvency. This is not credit losses. This is mark-to-market losses on very safe assets and drying up of liquidity. So while I still think that there are going to be problems ahead, the moves have been so big, so violent that yes, we've taken a large amount of chips off the table at this point, got much closer to home, because ECB meeting, Fed meeting are going to be critical in dictating where we go from here.
James Athey, thank you, sir, of Aberdeen.
Thanks,
going through some of these issues. Thank you very much. What a difficult moment. Bob Michael of JP Morgan Asset Management yesterday. Tip of the iceberg. Tip of the iceberg. And he basically put it like this. Look, I'm the CIO of a big asset manager. This is my impression of Bob. I'm not doing a good one. I'm not going to do one. He turned around and he said, look, I'm not going to lend to these companies anymore. And if I'm not going to do it, if I'm not going to allocate money into risky parts of the market, not many other people are either. Tighter financial conditions are coming regardless of what these central banks do today or next week for that matter.
This is brilliant because I take immense issue with this, we are the world, we should have all been in this together, and in Silicon Valley and whatever. We just should have, for the team, done this. Baloney. Bob Michael is going to manage the bond assets for Mr. Diamond, and that's the only job he has.
Well, and Silicon Valley is going to manage the assets for their portfolio companies and not try to save the bank that basically fed them for so long.
Thank you.
By the way, it was a great interview that you did with Bob, and what I thought was fascinating was there was a defensiveness. He said, everyone's been saying I'm wrong about being defensive and not going into high-yield bonds. Well, I was right, and I think there is this sort of defensiveness for people who've been calling for some sort of downturn and gotten a lot of heat for it.
I noticed that. Do you want the words that will haunt President Lagarde today and this whole governing council? Here they are. The governing council decided to increase the key interest rate by 25 basis points after raising rates 25 basis points in April 2011 from historically low levels. The further adjustment of the current accommodative monetary policy stance is warranted in the light of upside risk to price stability. Jean-Claude Trichet, July 2011. That's what haunts this ECB.
Yes.
Coming up, Peter Oppenheimer in the next hour from Goldman. Looking forward to that from New York. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
problem is that Credit Suisse, by some standards, might be too big to fail, but also too big to be saved. It's not clear that, unlike the United States, the federal system has enough resources to engineer a bailout. And what they need certainly is more capital, and the question is whether they're going to get that capital or not. Otherwise, bad things can happen.
I have to say, Nouriel was pretty measured yesterday. Nouriel Roubini, Chairman and CEO for Roubini Macro Associates. Should that worry us a little bit more?
Measured. He was still talking about how we're facing a stagflationary kind of battle that could potentially percolate into something really negative. But for Nouriel Roubini, that's pretty
Usually I walk away petrified. But yesterday I was like, okay,
It's an oil I've known for forever, and I really take issue with this. And you know, Simon Foy's been writing it up wonderfully at the Telegraph. But the first thing they lead with is he's Dr. Doom. He's not Dr. Noom.
Yeah, I hate
He's
that.
one of our foremost international economists. And what's important about these guys, and this is Steve Roach, Nora Rubini, Nassim Taleb, and others, John, they live on the balance sheet. Chris Whalen is a perfect example. These are people that don't look at the income statement. They look at the balance sheet, and like Bob Michael, they were way out front on these ratios. Don't look good.
Breaker 2 on Credit Suisse. So we're back to 199. We're positive about 17%. Big move overnight. If you are just tuning in, good morning to you. In Europe, you've been following this story all day, I know. Overnight, 145. Zurich time, the statement drops from Credit Suisse. They're tapping the Swiss National Bank for as much as 50 billion Swiss francs and offered to repurchase debt as well. So the stock climbed at the open, has faded since, still positive about 17%. The broader story for Europe, decent gains. The DAX up about 0.4%, even the FTSE in London up about 0.5%. But no real drama here. Elsewhere, I have to say, futures in the S&P are now negative. They're down about 0.1%. We saw some monster moves in the bond market, and yields are up at the front end, Tom, just by about 11 basis points. I say just because we've seen much, much bigger moves than that over the last few days. We're back to about 3.99, call it 4% on Tuesday this morning.
An extended Bloomberg surveillance today on radio and on television. Good morning to all of you. Way too early for all three of us just to be up this hour, but this is important. And it is Europe opening to a bank crisis. Providing leadership for Bloomberg with our terminal top live is John Patrick Barnett, joining us now, and Maria Tadeo on the ECB Watch in Frankfurt. John Patrick, let me start with you. You were writing up a storm on price move. You were writing up a storm on balance sheet salvation from SMB. You were not writing up a storm on the money flows in and out of this beleaguered bank. Do they need to come out this morning and state the January and the February flows that they observed?
Well, that would be very helpful, I guess, at least if we see some positive signs here. So what we got right now is, I would say, some painkillers for Credit Suisse, which is good. And I have to say, I'm positively surprised that the regulator was so fast to act here. And I mean, like, on the other hand, I'm not sure if this is a good sign or a bad sign. But still, it's a painkiller. It's not curing what is hurting Credit Suisse, and that is a profitability issue and like a very grim outlook for the earnings going forward. I still think the bank has probably struggled to improve that. And when you're talking to analysts and investment managers on the stock, they still say, like, okay, this is giving them some time. We're taking off the pressure for the moment, but the story is not over yet. And the question now is, like, what do we do with Credit Suisse going forward? Which is a reason why JP Morgan analyst came out this morning and said a takeover is the most likely scenario, some sort of combination, possibly a forced marriage with rival UBS. How much is that in the ether this morning, some sort of forced merger, forced sale that happens sooner rather than later? Well, I would say it's the most likely scenario, as JP Morgan has pointed out, because all the other scenarios are highly unlikely to happen. One would be like to give Credit Suisse just like more time on its own to solve the problem. It's clearly not an option, even like before the events of last week. That was a difficult thing with the 3-year plan, as the market is becoming very impatient. The other one would be like inject more equity into the bank. At this point, I would say also at least very difficult to pull this off. So all you're left over is like some kind of a merger. The question here now I would ask is, like, can you merge the bank as a whole, or do you need to split it up before? I would say it's probably the latter, and then you do something like that. You merge the domestic Swiss business with UBS and you sell off the investment bank to some other bidders or something like that. It's going to be messy. There's lots of details and uncertainties in there. But if I have to make a bet, I would say that it's probably something that we really could see like coming up in the next couple of weeks and months. Maria Tadeo, Christine Lagarde wanted to stay in bed today. She did not want to come out and address everybody and try to figure out how to thread this needle. What on earth does she do?
Well, look, I think what she's thinking is, quel timing, what a timing to have to be making this decision today. And we agree that just a week ago, and this just shows just how fast things have moved. This was a central bank that was on autopilot. It was 50 basis points, very well calibrated, core inflation sticky. And the message from the European Central Bank is we got to take decisive action. Obviously, we see this banking chaos going on, the fears around Credit Suisse yesterday, and that flipped sentiment testament to one key line that she said a month ago, not in the statement, but in the press conference. 50 basis points was a strong determination unless something, quote, extreme happened. That prompted a debate about whether or not Credit Suisse could be that extreme factor that could lead to a reversal to 25 basis points. Now, this morning, once again, the narrative changes. You see that the stock 600 for banks is positive, and a lot of the ECB watchers that I speak to today are now telling me, if anything, this proves the European Central Bank, single mandate central bank, they got to look past the volatility, stay with the data, and hike 50 basis points. But that is the tug of war today for Madame Lagarde.
Maria, two threads, and you can answer it any way you'd like in this moment. One is Macron's on the phone looking at BNP Paribas imploding, saying, let's go, let's go. And the other is a position of Joachim Nagel at the Bundesbank. What will Macron and Nagel do today?
Well, and remember, I spoke with the head of the German Central Bank a week ago who told me decisively the European Central Bank had to take action, or would have to take action, because core inflation was just absolutely not acceptable at the rate that it is, around 5%. Now, Emmanuel Macron today, by the way, is not focused so much on this because he's got a pension reform he's got to focus on. But what we do know is that the French finance minister, Bruno Le Maire, was on the phone with his Swiss counterpart because of the moves that we saw in the French banking system yesterday. I think today, again, more than Macron or the German Central Bank, it really comes down to Christine Lagarde. This is her job. This is what she needs to do, to come out with a strong message in this press conference, which will be dominated by this banking question, and really instill confidence in the system. Can she do that? I mean, we're going to have to wait and see.
Hey, Maria, thank you. Alongside Jan Patrick, to the both of you, thanks very much. The Bloomberg coverage on both Credit Suisse and on the ECB as well. Whatever Christine Lagarde does today should be criticised for it, because there is no good decision on a day like today whatsoever. And even harder, this meeting, Tom, just like the Fed next week, they have to provide some forecasts. Try putting out some forecasts. I mean, I want a share pound next week. If I was him, I'd hold back the SCP. I'd deliver them in the news conference. I would say, look, this is what we've done, but I want to be very, very careful here. We have absolutely no clue, no idea.
This is a really important insight in that, does this crisis have a more holistic, larger view where you get into disinflation and deflationary dampening influences, particularly on real GDP? Witness oil. I mean, to see Brent, we're not to 69 on Brent, 74.11 is shocking. But the idea that people are going to start marking down their GDP calls like OEC did yesterday, I think, is unspoken here.
It's too early to know. It's too early to know, and quite clearly for European banks this morning, it's too early to know too. So yes, you've got this big move in Credit Suisse after a monster move from the bank overnight to tap liquidity from the SMB. But let's take SocGen. You mentioned SocGen, right? We were down yesterday 12%. We're up this morning 0.5%. Does that sound like a relief to you?
God, John, you put me in the most uncomfortable situations.
You brought up the bank. You invoked the name.
It's my fault. Let me put it this way, folks. Each of these banks have a character and a history. And BNP Paribas, the giant retail conservative juggernaut of Paris, is not the math whizzes and derivative jockeys over at SocGen. That's a stereotype.
BNP yesterday came out and said they were going to reduce their counterparty risk through the derivatives market with Credit Suisse. These are ways to try to shore up its reputation. It's basically a way of saying, look, we're not at risk too.
And as far as we know, US banks have been doing that for a while as well. So some of this just really isn't new. Equity futures negative, Credit Suisse higher by 20% this morning.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Still trying to work out what I'm doing here. Maybe you at home are trying to work out the same thing. Tom,
I used to do
good
this
morning.
5 days a week.
Bramo, good morning.
Thank you. Good morning to you too.
It's coming at 5 a.m.
It's
used
not,
to love that, didn't you?
It's massively nonlinear. If you get 15 minutes more sleep through the morning,
yeah,
it's like exponential. It's a fancy.
You were sleeping during the show.
Function. I used to nod off. Yeah,
I'm aware.
I have honestly done that, folks. I have fallen asleep on air twice. Literally fallen asleep.
Would you like
air.
to share who the guest was at the time?
I think it was Freddie Late. I think it was Freddie Late.
Freddie, please don't go.
Let's go through the price action briefly. Okay, let's reset. Thank you. Equity futures down about a tenth. I want to look at Credit Suisse first. It's up 19%. Big move lower in yesterday's session. But this time yesterday, we were looking potentially to drop below 2 and thought that was dramatic. And right now we're back to around 2 Swiss francs on the stock. So yes, elevated off the back of the drama through the whole of yesterday. A statement late last night from the bank that Credit Suisse has tapped the Swiss National Bank for as much as 50 billion francs. They're offering to repurchase debt as well. Their top shareholder told Bloomberg yesterday, when asked if they'd provide more assistance, absolutely not. They talked about the regulatory reasons, but they also said there were other reasons as well. That same individual spoke to CNBC this morning and basically said everything's fine. It's panic, a little bit of panic that I believe is completely unwarranted. So do whatever you want with that. I thought it was bizarre yesterday, and maybe today's a bit of a cleanup act. So that's the stock that everyone's watching right now. Futures down 0.1%. That's not a major bounce, though I have to say the move in equities yesterday with the Nasdaq positive again, you'd never know what was happening elsewhere based on the index level story, Tom, in America yesterday.
Yeah, and the futures just in the last 25 minutes have come back. We had green on the screen, and we don't have green on the screen anymore. Can we all agree the EU bounce this morning is maybe a little tepid?
It's pretty tame. It's pretty tame stuff. You looked at Germany up 0.5%. Can I do a penny stock? We don't usually do this.
It's on the pink sheets. I thought that was just Credit Suisse.
The 2-year Treasury?
The 2-year Treasury. Bramo knows where I'm going. This is ridiculous. This is a 2-year Treasury bond. And look at what it's doing. Up another 13 basis points, 4.02%. And I went through the moves we've had over the last few days. 20 basis points Thursday, 28 basis points Friday, 61 basis points on Monday. Tuesday up 27, down 36 Wednesday. I mean, what's going on, Bramo?
Well, part of this, people are saying possibly is a liquidity issue. I mean, we're seeing volatility that we have not seen since 2008. But I do wonder whether this is basically a commentary on a lack of credibility and a lack of authority from central banking units. We don't have a sense of how they will respond to this. We don't have a sense of any consistency in messaging. We haven't gotten any. And I understand that the data has been very confusing. I understand that the actual macroeconomic picture has been very confusing. confusing. But there really hasn't been a steady guide in tone or approach for a number of months now, at least from the U.S.
This has been, and I said this earlier in the week, the biggest reappraisal of monetary policy worldwide in the smallest window, perhaps, ever. Only the other week, the Austrian central bank governor was talking about going 50, 50, 50, 50 at the ECB, and now we're asking the question as to whether they hike at all today.
We were talking about possibly a terminal rate that should have been more in the 6 or 7% level. People talking about how since nothing was breaking, there is a resilience in a market that suggests something that is a new regime. Suddenly we're talking about going back to zero.
Yeah, I want to get to our guests, but you're dead on, but there's twofold here. One is the level and move, and there are a lot of people calling for higher rates. Higher rates didn't ruin this economy. What ruined it was the first derivative, the rate of change. Boy, we got there quickly. And in hindsight, maybe we got there too quickly. Nevertheless, you got to get out to that rate after the Biden stimulus.
Jay Barry, JP Morgan in the investment bank, last 24 hours. Looking the gains in the bond market, he believes Lisa hikes are coming. That's a different view on this bond market right now.
Yes.
Not everyone has capitulated to this idea that they're done. I know the market is screaming they're done. I know there are several banks saying that the Fed's going to pause next week. Wells, Goldman, Barclays. But you still got B of A, Morgan Stanley, Citi, saying we get a hike next week.
I would say I spent a lot of time thinking about this question. What's worse for the market, if they do hike or if they don't hike? You asked this yesterday, you asked this the day before. Right now, if they don't hike, does that mean that they see deeper financial distress coming from banks that are otherwise saying this is not an issue with liquidity, this is an issue of confidence in the market?
We got to get to Mr. Late, but I don't agree with that at all. This is a central bank apparatus that has to look at banking integrity. Monetary policy right now, frankly, doesn't matter, and Lagarde's going to say that
but
today.
But right now, they've put the backstops in. They say that the banking system has integrity. So if they're saying that, then if they don't raise rates because they're concerned about banking integrity, well, that sends a message. That's my point. But anyway,
when a baby falls over, and if you make a big deal of it, it starts to cry. But if you don't,
100%, yes.
Is it that kind of moment? Are we trading $1 trillion of securities like toddlers?
Wait till my kids grow up before you.
The thing that I always hate for central banks, this is the number one thing.
You ever notice how the one without children is telling you about children?
The number one.
He's correct.
I know this from my nephew and my younger sister when I was a child, Tom, of course.
Very good, thank you.
Did you make a big deal of it? I'm guessing not.
I just wanted to make a point, if I can. And now I've totally lost my train of thought because you guys keep winding me up about all of this. For central banks right now, this is just tremendously difficult. For Lagarde a little bit later, I don't know what they do. I imagine they are worried about the psychological question you raise. I think it's a really, really important question as well. The issue I have at the moment, I think we started this debate last week and said, do they have the tools to address what's happening in the banking sector to allow them to carry on attacking inflation with monetary policy? I think the bigger question is it a mistake to isolate what's happening in the banking system to make a monetary policy decision? Because aren't the two connected somehow? We've been talking about this now for 12 months. At some point, something breaks.
Yes.
And when that thing breaks, or at least begins to crack, a lot of people are going to tighten up lending. Now, you'd imagine, regardless of what happens with the Fed next week or the ECB today, that if you are a bond investor, a bank, to some extent, you are tightening your lending conditions, right? You're tightening your standards. And Tom, if that's going to happen, if that's going to develop, then we should see the central bank have their job done for them.
And we're going to find where the zombies are of all different characters, and clearly in the zeitgeist, Credit Suisse is not the same as Silicon Valley Bank. That's one of the
absolutely
great ideas that we've seen. Let's get to our guest right now. We wanted to find somebody more miserable about his nation than this financial crisis. Freddie Lake did rugby at his Oxford as he studied mathematics and is mortified by the collapse in Six Nation rugby of England. Mr. Lake, we won't talk about rugby this morning. There's other matters. But let's talk about the Six Nations battle of EU banking. Are they all on the same page, or is it every nation, every central bank for themselves?
Morning. I think there's a big difference. I think what we're seeing at the moment, you just alluded to it in your conversation, is creative destruction, which is always a good thing. We've all known for the last 6 to 12 months we're going to need to see clearing events in different sectors, and banking's often the first. And so creative destruction is always good over the long term, but it's always painful when we experience it. And I don't know where this will spread, but I think the central banks have moved very quickly with very strong tools to try to contain these individual situations. So I think the contagion's limited, but the same impulse could cause more effects at other banks.
If we all go Joseph Schumpeter and enjoy a global creative destruction, is it a banking roll-up that makes the strong banks stronger?
Well, someone said the other day on one of the shows, there's two ways you can do it. You can either not let banks take over the deposits, or you can let them take them over. And either way, the deposits trend towards the bigger banks. And so, this will be, whether it's takeovers or whether it's actual business just moving into the bigger and stronger balance sheets, it's going to accelerate over the coming days and months and years, I anticipate.
Freddie, can you do anything in this environment in terms of investing?
I hope so. It is my job. Look, it's hard. I think the reason why we're seeing things like the 2 years jumping around as much as been pointed out, and stocks and markets in general, is because we are going through a change of regime, and it's taking time, and it will take time, years, before people get hold of what the next regime looks like. We expect a lot more volatility, and we expect sort of sideways moves in markets. But that doesn't mean there's not something to do, especially within the equity market. Even within banking, I think something like JP Morgan or Bank of America or Goldman Sachs perhaps are already looking interesting at this point on a multi-year view. But outside of banking, and there is a huge amount of other stocks to look at, there's plenty of businesses that can grow through the environment as we see it and come out stronger. So I think there's a lot to be done. I think it's actually quite an opportunity-rich environment. But you've got to understand the regime's completely changed. We're not going back to the kind of buy the dip, Fed bails you out on monetary policy. They're bailing you out or helping by containing systemic issues in banks, but monetary policy is quite independent. The linkage obviously being financial conditions.
We've been talking about regime shift for a while, Freddie, and the funny thing about it is that people have come up with a different regime every 5 minutes that we're heading into. It's very difficult to get a handle on what that looks like, and in the meantime, people are going back to the tried and true. Yesterday, when you saw bonds rally so significantly, you saw tech outperform in the U.S. At what point will we understand what this new narrative is, especially if we do get some sort of recession, we do get some sort of crisis that leads to lower inflation than people previously thought?
I think it will take a few years. I mean, I think even when you think back to the most recent one, the financial crisis, it was really, by 2011-12, we were still going through European banking crises, sort of Greece potentially going bust. And then we had the TLTRO and the Draghi moment in 2012. And at that point, you kind of got the measure of it. The central banks are here to support and inflate the asset side of the balance sheet of the economy. And that was the sort of trigger, really. It was 3 years later till you had clarity. And even then, if you'd spotted it in 2012, you were quite early. Most people got it in 13, 14. So that's 5 years later. And I think that's what we're in for. I think these regimes take a long time to reassert themselves. And in the interim, we have volatility and no real direction for markets.
Freddie, let's pretend there's no crisis. What's your sector overweight this morning?
We actually are rather dull. We rather run a sort of balanced book. But I think there is a reason why certain defensive sectors have been doing well. But I think irrespective of the crisis we're seeing at the moment, one of the themes that seems really likely to play out over the next 5 to 10 years to us is the capex replacement cycle, reinvestment cycle, reshoring, and everything that supports that. So I think plays on that, which might be capital goods companies, I think to a degree energy companies, or other industrial exposed companies. While right now, obviously, we are risking running into a recession, most of the businesses are priced for that. And on a multi-year view, I think that's a decent overweight.
Hey, Freddie, thank you. Freddie Late there on the latest in this market. Can I just share this with you? Based on our survey for the ECB today, every single economist is looking for 50 basis points with the exception of one, Deutsche Bank. They're looking for 25. Now, some of these forecasts are a little bit dated. They're from March 9th, etc. But, Tom, that just gives you the tone, the flavour of things going into this ECB.
I think, uncertainty. This is, my favorite book. I've bored everybody with it. Peter Bernstein, Against the Gods. And there's risk. And then there's this strange thing, uncertainty. John, uncertainty is not risk, and uncertainty is not fear. Uncertainty is I can't figure out what to do with my math to make a guess. And right now, I'm not sure there's much math going on here. It's mostly, as Freddie brilliantly said, we have to clear markets.
So there's two things, Tom. One, the decision today, and next, the uncertainty around the next decision. So we thought they'd pre-commit to 50 today and maybe do it again for the next meeting. So the option that's available to them is just to say, truly, and I think they can say this now, because they've got to say this, truly, there is no forward guidance. This is meeting by meeting. We'll see what happens.
Yeah, absolutely. I mean, in Lisa's idea here of, delay or whatever is actually in play. And Jermaine, what I'm stunned by, and I think it's cultural, is in 2008, people were out front and visible. The Secretary of Treasury was visible every day. Mr. Diamond was visible as he considered Bear Stearns, et cetera, et cetera. CS with Francine Lacroix the other day was basically invisible, and they've been invisible for the last 3 days. Get out there in front of a mic and say something, but that's not the Swiss way.
What would you like them to say? What do you think would get it done?
I would like them, as I said to John Patrick Barnett, the heart of the matter is flows to their flagship wealth management. They have to clarify flows, good or bad.
My problem is that right now they can't really clarify with any story that's going to really shore up morale and give a sense forward, because right now they're facing a lot of uncertainty. This is a tricky moment, and that's the reason why it's so hard to give clarity. There is none. And so what do you do as a policymaker?
I don't think there's a difference between 2 Swiss francs and 0.5. What's a hundredth of a Swiss franc? I don't know, a centime?
Something like that. Yeah, great.
I think we need a road trip.
I mean, when I'm at the McDonald's,
see how our trips went over there.
Just down from Credit Suisse, there's a McDonald's. A number 2 value meal is $14.
That's really not where
$14. I just throw them 20 euros and put them on.
Oh, you give them euros.
Yeah, I do that. I just do that. They convert them.
Okay. The futures right now, down about 1/10 on the S&P.
$14 for a number 2 value.
Credit Suisse 2-handle, just about holding on. It's positive on the session over in Switzerland, up by almost 22%. In the next hour, Ian Linnan of BMO Capital Markets. Looking forward to that conversation a little bit later. From New York City this morning, good morning.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
ECB has to acknowledge that they've got to ring fence things and make sure that they put enough firewalls in place actually to help CS, let CS get time, but more importantly to ensure that there's no chance of this attracting the attention of other banks.
Peter Cheer there of Academy Securities on the latest with the banking situation. Here's the latest right now over in Switzerland. The stock is higher by a little more than 20% on Credit Suisse. The news last night, overnight, a statement at 1:45 a.m. Zurich time, that Credit Suisse was ultimately tapping the Swiss National Bank for 50 billion Swiss francs, offering to repurchase some debt as well. Is that enough? Is that enough? We're looking at European equities right now. Getting deeper into the session, equities over in Europe, positive. The FTSE up 0.75%, the DAX up 0.4. On the periphery, we're doing okay. Futures here in the United States, as we just wake up and gauge things, we're down about 0.2% Going into the ECB a little bit later this morning, with euro dollar looking like this, 1.06, up 1/3%, and President Lagarde firmly between a rock and a hard place. We've all had these conversations with investors about what they like. They say we're defensive. Okay, tell me what defensive is. And they say, well, like high-quality assets and fixed income. I'm like, tell me more. Yeah. And they're like, investment-grade credit. And my response is, wasn't SVB investment-grade like a week ago? Yeah. You know, like, don't we have to rethink some of this stuff, Lisa?
First Republic, which was just downgraded to junk. I mean, how do we look at all of these safe assets, especially when you have volatility in the safest of safe that is akin to what we saw in 2008?
And this, Tom, is before we get to the risky stuff.
I'm looking at this as in equities and bonds, as Freddie said earlier, we're going to clear the markets, and we're doing that right now. And in Credit Suisse, we're clearing this morning, and you know, stability at 2 Swiss francs, John. But as we go through the morning, and we have to hear from them. That's, as I said.
Well, just to give you a flavour of high yield spreads, Tom, they were 390 last Tuesday, and right now they're 511. So that's some real spread widening, Lisa, that's come through this market in about a week.
And Matt Mish put out a note of UBS and basically said, what are we pricing in with credit spreads where they are? And still, he says, they're not pricing in the kind of distress that you could see if there truly is. And this is really the key question, and you guys both have been talking about this, Tom, is if you do get a pullback of banks lending, a real profound fundamental tightening in credit conditions.
We're going to drive forward here on this special coverage that we have this morning on radio and TV around the world, and we're thrilled to bring you a gentleman with big bank experience and strategy at JP Morgan and now at Tricumen, a managing partner. Seb Walker joins us this morning. Seb, you know Canary Wharf really, really well. You know the distance from, say, 1 Cabot Square to 25 Cabot Square, Credit Suisse to Morgan Stanley. Great. Credit Suisse has to get along with its brethren. That's the wheelhouse of what you do at Tricumen. How does Credit Suisse speak to other major banks this morning?
So I think where we are now is probably a culmination of a long story of a lack of clear business strategy by the bank. So if we step back, you know, post the financial crisis, Credit Suisse was trying to restructure itself. It's gone through a number of changes. We've seen management reporting and reporting out to investors change numerous times. We've seen lots of restructuring, but nothing that's had a clarity of the kind of restructuring we saw at UBS. And as a result, we have UBS now in a very solid position. We see their deposits have hardly changed in recent times, whereas Credit Suisse is suffering from this lack of clarity and essentially having the wrong business mix in its investment bank in order to match up its wealth business.
One of the great themes I've seen in 10 years is the discussion of within-country mergers. UBS Credit Suisse is one thought, or cross-border banking mergers. They're really hard to do, aren't they, in Europe? Are we anywhere near somebody could come in from other EU nations, including the United Kingdom, or dare I say from America, to take out parts of Credit Suisse?
Yeah, that's an interesting one. Certainly, if you look at the European banking sector overall, we, as a firm, see very few strong players. We think Barclays is in a very strong position. It has a clear strategy with its transatlantic focus, but it's not really in a position to make big acquisitions at the moment. Some of the French banks, BNP Paribas, seems to be pretty strong, but again, I wouldn't see them reaching out to make a big acquisition anytime soon. And as for the rest, you know, I just don't see they've got the kind of firepower right now. It's very much been, in recent times, a story of US banks taking advantage of the stronger US market, while Europe has been generally weaker.
Seb, when you talk about BNP, we talk about the contagion not necessarily with respect to any fundamentals, but with share price, with sentiment that we see in investors. How do you parse the sentiment as expressed in what we saw yesterday from the reality, from the fundamentals of banking, which are tied to sentiment so intimately?
Yeah. So I think there are three things going on. Firstly, there's an element out there that is taking bits of data and extrapolating too far. You know, if you look out at some of the retail investors, we've got people suddenly scurrying around trying to understand what unrealized losses are, for example. So that's one dynamic. The other one is just a straight sector fear, I think, and a general feeling of, okay, this is a sector we perhaps aren't comfortable with. And the third, I think, though, as I said, is really a lack of understanding of getting under the hood of what the business model of all these banks are. If we go back to the financial crisis and look at Lehman Brothers and Bear Stearns, when you pull apart their business model, a significant portion, and I forget the exact numbers, but over 50% was essentially a bet on the MBS business, which in itself at that time was a bet on the US housing market. So when you start to pare back what the business model is, I think we can get a much better understanding of the real risks and opportunities of any given bank.
Seb, as you parse through everything that we're talking about and the uncertainty, when do you get the confidence that we've seen a bottoming out, that there's an opportunity, not just in the biggest and the best, but also in some of the most beaten up?
Yeah, so I think this needs two strands. The first one is the regulators. It's helpful what the Swiss are doing right now to try and step in and provide some comfort, but I think they could be more aggressive with that. The lesson, I think, of the financial crisis is bold moves by regulators early on help quell the situation. The other thing that was mentioned earlier on is transparency. So, you know, if we look at the last reporting, someone like CS, so they've lost, I think, 43% of their deposits. Half of those are from foreign investors. The Swiss deposit base has been more resilient, but we don't know where that is now. And I think having a better understanding, having the management come out and state what the situation is, what their plans are, I think would certainly help calm things.
Hey, Seb, thanks for your perspective, your insight. Cool, calm heads prevail on mornings like these, Tom, that's for sure. Seb Walker of Tricumen Managing Partner. I was asked last night, and I'm sure you were as well, by many different people, are we on the precipice, the edge, the brink of a financial crisis? And my answer is just, I've got no idea. We've got to work through some stuff. I said this, though, if these issues came about pre-crisis, without a doubt, we'd be going into a crisis because they didn't have the tools, the whereabouts, the understanding of how quickly they needed to respond. All of the things that Seb was just discussing there. Think about what we did on Sunday evening. Would that have happened back in 07, 08, or would they have dragged their feet around some of these issues?
They understood exactly what Seb just said, that the faster and the more you come out with something significant, the more you're going to stave off some of the contagion. And that's why I think we're all asking, is it enough? If it hasn't yet fully stabilized the situation and is more needed, to your point, Tom, about leaders coming out.
Again, I'm going to look at the magnitude that we've seen in lift in rates. I'm not going to go into the math, but I did a fancy log study of the Fed's, the U.S. central bank rate, and the answer, as John mentioned earlier, is never before, is where we are. And the quickest way to solve the slope of that move up and its agony and get to where Dudley and Elarian, as two names have mentioned, is to pause and bring the slope out as you pause. There's a certain comfort to pause right now. Talk about data dependent, maybe they're news dependent as well. Maybe that's a new phrase.
Just in terms of standing up and being transparent, I think you're right, of course, but ultimately, these guys would be criticized whatever they did.
100%.
If they're on TV every single day, we'd be criticizing for that too.
And if they said we're getting complete outflows and all of our Swiss clients are leaving, I think the people would be like, really? This isn't helping.
It's not going to help anyone.
So if we did that hour, do we get to go home an hour?
We do. We won't be here next. Up next, Matt Miller. Don't worry, Matt. Stay in bed.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The problem is that Credit Suisse, by some standards, might be too big to fail, but also too big to be saved.
This stock has been in a huge downfall for 2 years. So there are clearly problems within this particular institution.
We simply don't know the degree to which this is systemic or isolated.
As a global bank, there might be counterparty risks for some of the U.S. banks.
If one gets into trouble, people very quickly start looking, oh, what's the next one that looks remotely like this?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We've got a long day ahead of us, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Equity futures right now, negative 0.1%. Credit Suisse is flying. Here's your bounce, up 21%. Here's the story, though, still in and around 2 Swiss francs a share. Tom, overnight, late last night in Zurich, 1:45 a.m. 1:45 a.m. the statement drops. That's happened in the S&P. For 50 billion Swiss.
Well, it shows the urgency of where we are right now. We've had a bounce. I don't think the bounce is as important as off the opening bid this morning, John. We were down 17% here, nicely above 2 Swiss francs. We've just got a little bit of a bid here in the last hour. And you say to yourself, okay, what's next? They're going to mop up the bonds from that transaction. But what's next is this bank has to provide clarity on their core profit machine, which is wealth management. They've not done that.
So let's talk options. The team here at Bloomberg reported yesterday the Swiss authorities and Credit Suisse were discussing ways to stabilize the bank. One option was a public statement. We got one yesterday afternoon. Then we got the follow-through overnight. Other options, Elisa, let's talk about those other options. Separation of the Swiss unit, a tie-up with UBS. These are conversations, and you said it earlier on this morning. We've got no idea what the conversations are behind closed doors. No idea whatsoever.
Which is the reason why Jim Reed over at Deutsche Bank put out a note this morning where he basically said, yesterday was a day you could look at the screens and really wonder what, as a research analyst, you can really say that helps anyone. The situation is fairly binary, and you are not privy to any of the conversations behind the scenes. That is where we all are as they try to come up with some solution that may be very market moving, and we just don't know.
You know, we give out an award every month here, folks, the Gnomes of Surveillance for our person in the control room with the least communication skills. And, you know, it's like the Gnomes of Zurich. It's about silence. It's about quiet. I mean, the heritage that they're dealing with is a heritage of secrecy. It's not a cliche. They're not used to the vibrancy and visibility of Silicon Valley Bank over the weekend.
Hasn't that been blown up over the last 10 years in that country?
I don't think so. This
Isn't
is
that
a really
culture's
important.
really sticky?
I think it's changed. That's what my reporting is. It's amended. Davide Serra is brilliant at this, the great bank analyst. But, you know, I would say, and I think Davide would say, a lot of it's still cultural.
I take your point, and I'll take it a step further. Perhaps this is one reason why it makes it very difficult for there to be a cross-border merger, because the culture is distinct, and the culture of banking in Switzerland is distinct. And so if you have a U.S. bank coming in or some other bank with a very different culture, it becomes difficult, which raises a question of who would be the tie-up with. If it's UBS, how do you insulate something so that it doesn't create a liability for someone that has otherwise shored themselves up?
ECB up next.
Oh, yeah.
Wow.
Over to you, Christine Lagarde.
Over to you. 50, 25 or nothing at all. I mean, there's some people out there talking about cuts. I'm looking at you, Nomura, and the Federal Reserve next week. Unreal. Futures right now, let's whip through it on the S&P 500. Negative 0.1%, just a little bit softer here. Over in Europe, a lift to the equity market. Let's pick out the DAX, for example, up 0.5%. In Spain and Italy, up 0.7, up 1%, respectively. Looking at the bond market, yields higher, 3 basis points. So 348.85 on a 10-year. The 2-year trading like a penny stock for the last week or so, just south of 4, 3.99. Lisa, the 2-year up 11 basis points this morning in the US.
It's unreal. The volatility that we have not seen in the benchmark rates of the world, frankly, unlike what we've seen since 2008. We are watching today literally as Credit Suisse shares and shares of all European banks. Are we there yet? Have we stabilized? And if you take a look at the stocks bank index, you are seeing a bit of a bounce, but not enough to give us that sense. And that really has been the question. Then at 9:15, over to you, Christine Lagarde. What do you do? The ECB rate decision followed by her press conference at 9:45 a.m. Eastern time. Does she punt? Does she say, we're going to reconvene in a week and tell you what we're going to do? Because they're kind of damned if they do and damned if they don't, between a rock and a hard place. And this market cannot figure out what they are going to do other than bring down the rate hiking expectations. And then at 10 a.m., more potential guidance from U.S. Treasury Secretary Janet Yellen. She's testifying before the Senate Finance Committee. Ostensibly, this was supposed to be about President Biden's plan for the budget. It will not. It will be about Silicon Valley Bank. It'll be about the small and medium-sized banking system more broadly. It'll be about the interconnectedness of U.S. and European banks at a time when still this central bank is hoping to raise rates to curtail inflation, John.
Lisa, thanks for that. Let's go straight to the guest, Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Peter, great to catch up with these really difficult moments, so thanks for carving out some time in your schedule.
Thank you.
You did like European banks. The facts have changed in the last week. Do you still like them?
We do. Clearly, in a situation like this, there's massive uncertainty, and I think the volatility that you've been speaking about and Lisa discussed is going to continue. But I do think it's important to recognise the underlying fundamentals here are pretty good. You've got strong capital buffers, core Tier 1 capital of around 15% compared to about 5% for the European banks during the crisis in 2008. You've got stable funding dynamics, 1.8 trillion of excess deposits, and you've got very ample liquidity. The liquidity coverage ratio is around 150% at the end of last year. So it's a very different fundamental situation. And indeed, rising interest rates, which we've been seeing, is actually very good for the banks. But, you know, confidence is everything. And while this uncertainty continues, they're likely to remain volatile. But they are cheap, and I think they're fundamentally in a relatively strong place.
Peter, we note your decades of experience in seeing multiple crises. I know you've been to Zurich any number of times and know that what matters is to take lunch at the Kronenhall, Das Restaurant Kronenhall. That's what everybody does in Zurich. It's the only place to eat. I get it. But when you're eating there now in this crisis at Kronenhall, is Switzerland part of Europe, or is Switzerland still separate from Europe amid this crisis?
Well, I don't think in a banking crisis that anything is really separate, and particularly in a banking situation where you've got cross-border integration and connectivity. So other central banks around the world will be talking to the Swiss authorities, and I think will be also preparing statements or willing to provide as much liquidity that's required if the situation continues to unwind. Obviously, there's a difficult decision that the ECB have got to make, as Lisa was saying earlier. But I think, again, they will emphasize the robustness of the underlying system and their readiness to provide liquidity using some of the existing tools that they already have, potentially providing more. But I think they'll take some comfort from the underlying balance sheet strength of the banking sector in Europe, which, of course, we couldn't have said a decade ago. So I think from that perspective, it's a much more robust underlying situation.
Peter, will you still be bullish on European banks if the ECB does not hike rates today and indicates that they're on pause until they have more clarity?
I think that it's very unlikely they'll say they're on pause, because that will, if anything, provide some sort of sense that they're concerned about the contagion effects of this. I think they've got to look at the underlying fundamentals of the economy. Actually, that's looking pretty good. We don't expect a recession this year in Europe. Inflation, core inflation, underlying inflation is above their target rate. They've signaled quite strongly that they expect to raise the rates by 50 basis points. And the banking system, again, as I would say, appears fundamentally resilient. And so I think they would want to sort of stay the course, but at the same time provide statements that are reassuring about their willingness to provide liquidity, to emphasize existing tools that are in place and that have been built up over the last few years since the sovereign debt crisis, and their ability to look at other things as well if it's required.
And Peter, do you think that tighter financial conditions, tighter lending standards are just inevitable now after what we've seen in the last week?
Yes, I do. And I think this is all really a function of a massive shift in the cost of capital that we've been seeing over the last year and a half. I mean, you only have to go back a year and a half, and about a quarter of all government debt around the world had a negative yield. People were paying for the privilege of lending money to governments. That world has changed. You're getting close to 5% on US dollar cash with zero volatility and risk, and that's a high hurdle for asset markets to pass. But it also means that there is a tightening in financial conditions and a rise in the cost of capital, which is inevitably having an impact on pushing valuations of assets down, and it's clearly causing some friction in areas of the financial markets. But if the underlying situation is robust and the capital buffers are in place, it won't prevent these problems, but may restrict the contagion and the systemic fallout from them. And that's I think, fundamentally the important point to take away from this.
Delicate moment. Peter, we appreciate your time this morning. Thank you.
Thank you.
Peter Oppenheimer there of Goldman Sachs. I think we're all bracing for this now. Just GDP cut after GDP cut after GDP cut.
That's where I am.
Because of what Peter just described at the end there.
Yeah, the outcome of this, and there's been a number of notes in this. Doug Cass, let me remind everyone, Doug Cass was a world-class bank analyst a few years ago, small startup firm, Kidder Peabody, back, this is 5-10 years ago. And Doug said, he went right to that. He said the outcome of every crisis is dampen consumption, dampen investment.
Well, and Goldman Sachs, so his peer, Peter's peer, Jan Hatzius, put out a note basically raising their recession forecasts based on exactly that. Tighter financial conditions, all the way to 35% in the U.S., which is still really below.
Goldman Sachs.
Yeah, which is still below the 60% median of economists surveyed by Bloomberg.
We're struggling to be light here in the midst of this huge crisis. And I mentioned the Kronenhall there, which is one of the most magnificent low-key restaurants I've ever been in, John. So I'm there one night in Zurich, and you know how expensive it is. I mean, you and I have
We've been there, yeah.
So I go in, and like a rack of lamb was $200. I'm like, oh, that's not going to happen. So I go, let's go prudent and reasonable, because Red O'Keefer of the Amex would want me to be.
Right.
The meatloaf at the Kronenhall, and it's just the meatloaf, not the carrots.
50 Swiss.
$59.30 US for the meatloaf.
I think Tom's asking for breakfast.
I think he might be hungry.
I think that's the case.
He keeps going back to this. You're a little bit hungry.
I don't know.
Just a little bit.
I was with this girl from Indiana, and she just said, okay, we'll have the same of that.
Let's pause, and maybe you can tell us about that story later. Dominic Constant of Mizuho is going to be with us a little bit later this morning. Next hour, this is Bloomberg.
We waiting for that story. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. The chairman of the U.S. Joint Chiefs of Staff, Mark Milley, says he doesn't know if a Russian jet collision with an American spy drone near the Black Sea was intentional. But he says the U.S. has video evidence suggesting Russia's actions were aggressive. Defense Secretary Lloyd Austin and his Russian counterpart, Sergei Shoigu, spoke yesterday in what appeared to be an effort to reduce tensions. Poland's defense minister says the country is in talks with Slovakia on transferring Soviet-era fighter jets to Ukraine. Earlier this week, Poland's premier said that a delivery could take place in the next 4 to 6 weeks. It's a move that would cross a threshold among NATO member states that have drawn the line at offering Kyiv air power. Emmanuel Macron's pension reforms face a final vote in the National Assembly today. If there's no agreement, the government could use the controversial Article 49.3 to pass the bill without a vote. Speaking exclusively to Bloomberg, former French President François Hollande said he's worried the ongoing strikes could deter foreign investors.
The risk, if there is a continuation of the social conflict beyond the passage of the law, even if I think that this risk is low, is that it could indeed dissuade investors from coming to France and give an image of France which is fairly consistent with prejudice. But I think that the government should focus precisely on finding forms of dialogue and opening a new phase discussion, in particular with the social partners and the most reformist trade union.
Notamment avec les partenaires sociaux et le syndicat le plus réformiste.
Global news powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
Our studios in New York and San Francisco, our new hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
If you do not manage your balance sheet well, if you don't manage your bank well, it will be a matter of time before you see trouble. I don't think it's a Lehman moment, by the way. I think that this is really bad, and of course it can get out of control, but I don't think that central banks or anyone else can just sit and watch this.
The Saxo Bank founder and CEO, everyone's got a view on this situation right now. Credit Suisse, good morning to you. Credit Suisse looks a little something like this. It's up by about 23% in Swiss trading after tapping the S&P for 50 billion Swiss franc overnight. We're back to about 210 on Credit Suisse's stock. This from JP Morgan a little bit earlier. Here's the quote. We see S&P liquidity support as indicated last night as not enough. We believe the situation is about ongoing market confidence issues with its IB strategy and ongoing franchise erosion. 1, a complex IB restructuring with limited details. 2, ongoing deposit and net new asset outflows, although moderated year to date, still an issue clearly. And 3, wealth management historically generating an average of 1.8 billion Swiss pre-tax, but currently loss-making. In our view, their view, the status quo is no longer an option. They offer a range of scenarios, Tom, over at JP Morgan. This is the investment bank on the south side, one of the analysts out there. Here's one of the options, takeover scenario, UBS, likely the leading candidate.
Culturally, it's got to be. I mean, we're making jokes about this restaurant in Zurich. It's not funny in Zurich, John. It's a two-bank town with a lot of private banks, but there's a heritage there that you just feel in the air. And to be honest, these majority shareholders, including Saudi Arabia's central bank money, they want to come in and acquire that air, and that's what they thought they did, and profitability.
We are at that stage where this is part of the conversation. I wonder, Tom, what people would think about, say, Julius Baer. Do they really want to go to one monster bank in Switzerland, or do they want to boost up Julius Baer, beef that up and have some kind of combination? But as I say, this is all highly speculative stuff right now, and stuff the C-suite at Credit Suisse doesn't even want us discussing, because ultimately they want to get through this. They really want to get through this.
Let's be honest here. I'm the amateur here. John, you spent a lot more time there with Manus Cranny and Francine than I have. I mean, the new Zurich is different, as Lisa mentioned, from the stereotype of years ago. Yet we're, Americans particularly, I think, we have a baggage of the stereotype.
But this conversation with this bank, Tom, often tell the story about going over to see Brady Dugan when he ran the bank, I think more than 10 years ago.
I know where you're going with this, but
about a decade ago, and the same questions were asked about the investment bank then. Here we are.
It has been a decade-plus train wreck. I would say that. Let's do this. What we've really tried to do overnight in this special edition of Bloomberg Surveillance is not find people, blah, blah, blah. Boy, is there enough of that going out there? We're trying to avoid that. And we do that by finding people that have the experience. Michael Kunz is with Luzerner Kantonbank. They are in Lucerne, and it's a big deal in Switzerland to have these separate canton banks, which are the heritage and fabric. He has done tours of duty extensively at the Union Bank of Switzerland and also at Credit Suisse. Mr. Kunz joins us this morning. Michael, thank you so much for coming on. Can you imagine UBS and Credit Suisse? You've worked at both. Can you imagine them merging?
Frankly speaking, no. The competition authorities would have a problem, and the complexity of the merger is just too large to be surmounted. That's a very complex task with overlapping wealth management in all sectors, in all regions. People that have been banking with Credit Suisse so far have deliberately not been banking with UBS and vice versa. And a merger of those two would see a ton of merger-related client attrition.
Michael, one of the great heritage we've seen, we talked about this, I believe it was yesterday, is traditional EU executive management. And then, for example, at Deutsche Bank, Mr. Saving came in to save the day with a more verbal, more outgoing management. Is the major challenge at Credit Suisse is they're working under an old EU model and they need a new executive regime to create action to fix this crisis?
That's probably one factor of the whole bundle of problems. I mean, they have had quite a few management changes the last couple of years, but ultimately each new leader has just reshuffled some org charts in the PowerPoint presentation, and the strategic setup of the bank has not really been altered sufficiently. Michael. And they need to get something moving. It's still not clear what this bank is supposed to look like in 2 or 3 years' time.
Michael, we've talked a lot about how banks in the U.S. and even in France have tried to immunize themselves from potential difficulties at Credit Suisse. They've spent a couple of months doing so. Is Credit Suisse still systemically important from your vantage point?
It's one of those big-to-fail banks still for a country like Switzerland, even though the bulk of the business is outside Switzerland. And nobody wants to take the risk that this giant ultimately collapses. So that's why the S&P did this preemptive strike. with the additional liquidity facilities, even though the fundamental ratios are still looking normal at Credit Suisse. But the market was wondering how much more outflows does it take before they cease to look normal.
Michael, there's also a discussion about where the deposits are from, where the client base is from that use Credit Suisse, and whether that makes it very difficult for a U.S. bank or even certain European banks to take over or merge with Credit Suisse, given that there's a large base of Middle Eastern and Chinese investors that become kind of difficulty in a different kind of transparency regime. What's your view on that?
It would be a certain challenge, to put it mildly. I mean, people have all sorts of options where they can do their wealth management or private banking in Asia. The big Singapore banks, for example, are an important player. And if somebody chooses to be with a Swiss bank, I'm not sure he's 100% comfortable if this tomorrow would be a French bank.
Michael Kunz, I want to finish on this just briefly. We talked Sunday evening after the action in the United States. Was that sufficient? Do you see the move overnight from Swiss authorities together with Credit Suisse as sufficient? Or do you think that's just a Band-Aid?
That depends on a lot of different factors. I mean, are markets, equity markets further collapsing, or are they kind of stabilizing because collapsing equity markets erode the revenue base for Credit Suisse? I think for the moment it's quite a big statement, and it kind of should slow down people who are pondering upon withdrawing their money at Credit Suisse. But ultimately, I would say Credit Suisse is not out of the woods yet.
Michael, thank you, sir, for your perspective. Michael Kunz there on what's happening with Credit Suisse at the moment. It's up about 23%. One of the options that the investment bank at JP Morgan suggested on the research side of things, that the S&B could step in with a full deposit guarantee on all deposits. Just a range of options out there, Tom, that people are still discussing this morning.
The range of options. Well, we started there. Mr. Heimers was out yesterday, you know, obviously with UBS at a distance from this debacle. And I am struck by people that actually have experienced this are just no way you could see a UBS Credit Suisse merger. And I just find that bizarre. I mean, really? Why couldn't that happen? And I never had a straight answer.
Would you want just one major bank?
Oh, no, you don't want one, but you don't have a choice right now. When you're overcome by events, yeah, absolutely. But it's just, they just say that it's unthinkable that they could see them merge, and I would like to know why.
What's more unthinkable, a tie-up between the two beasts of Switzerland or a foreigner buying the bank?
I don't have the answer to that, other than people are quite forceful that they really don't want the Americans to come in.
That's what I hear too.
Yeah, so, you know, it's a mystery.
I also hear that the Americans don't want to come in. So that's another issue, is that they don't want the assets. This issue, though, that JP Morgan raises here, which is they can't do nothing because they have to shore up confidence. And it's not just avoiding people leaving in terms of clients. Why would they stay in terms of the reach, in terms of the talent retention, in terms of what they can potentially offer?
Do you remember Tidjane Thiam? Do you remember his time at the bank?
Yeah.
That seems calm compared to this, and that was anything but calm.
You mentioned Mr. Dugan earlier. I'm sorry, this has been because of where we are with the bond dynamic and the central bank dynamic, that we've come to a crescendo of 10 years.
Equity futures right now unchanged on the S&P. Credit Suisse higher.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Live from New York City, good morning to you. Equities, negative, just Credit Suisse, the one to watch. That stock is bouncing today by more than 23%, up 23% after putting out a statement overnight. Keep going back to it, just 1:45 a.m. in Zurich. These guys have been up all night announcing that they're going to tap 50 billion Swiss from the SNB, the Swiss National Bank. Going to rebuy some debt, repurchase some debt as well. Is that enough? Is that sufficient? The stock is higher by 24%, but basically still in and around 2 Swiss franc per share on the stock. Elsewhere, I'm looking at futures, just slightly negative on the S&P. No drama here on equities. On the NASDAQ, Lisa mentioned this the other day. Yields lower, NASDAQ up. And it's just sort of like reflexive. Never mind the earnings story. Who knows? Okay, the NASDAQ up a third of 1%. Going to get to the bond market. Your 2-year looks like this, up 14 basis points on a 2-year, 4.02%. It was sat the 4 a little bit earlier. This 2-year note's been all over the place going into the Fed next week. The ECB coming up a little bit later. But let's finish on this name right here. First Republic. Now, this is tricky stuff. First Republic, down 16% in the pre-market. Now, we've reported that they're weighing options, including a potential sale, Tom. That stock down in the pre-market and not looking great, is it?
There are two stories out there, and it's the way this is going down, John. This is not like Credit Suisse yesterday rolling over as the bid walked away. Technical analysis doesn't matter here. 5, I can give you the exact time in the Bloomberg, John. This is East Coast time for those of you worldwide. About 5:50 a.m. down. Right now, that was 40 minutes ago, and a new leg down just moments ago, John, as you highlighted that here at 6:20, 8 minutes ago, boom.
I want to go through some details from our reporting from Gillian Tan and Matthew Monks. They say that First Republic, which of course was cut to junk by S&P Global Ratings and Fitch just yesterday, is exploring strategic options, including a sale, according to people with knowledge of the matter. Now, there's tons of speculation about the positions of individual banks. Then we have to let the statements of these individual banks be heard as well. First Republic on Sunday said this, that it had more than $70 billion in unused liquidity to fund operations from agreements that included the Federal Reserve and JP Morgan. And yet still, Lisa, this stock is still struggling.
This is what S&P wrote in their downgrade to junk. By the way, in terms of pile-on, this is quite the thing when S&P and Fitch come out right after you've already seen some of the drama in the markets. We believe the risk of deposit outflows is elevated at First Republic Bank, despite the actions of federal banking regulators and the bank actively increasing its borrowing availability to mitigate risks associated with bank failures over the past week. Basically, the hysteria around the potential failure of small and medium-sized banks has a snowball effect. That means that S&P and Fitch don't have confidence that this can be considered an investment-grade bank. And a bank without an investment-grade rating, very difficult when it is counterparty risk and it is credibility at the fore.
I'll be honest, I ignore the ratings. I think they're always behind. They're behind. There's something else going on here, and it looks to me like Sunday with Silicon Valley, where there's speculation about who's going to acquire this bank, and many people say this is the one bank, John, that has a value, has a sense of corpus, a oneness to it that could be acquired. And you've got to look at the share price action and say there's things we don't know that are not good.
I think what you just said, Tom, probably resonates with a lot of people. They don't care about the ratings either. Unfortunately, there are some investors out there that have to care.
They have to
what
care,
this
yes, yes.
is rated because it dictates where they allocate capital. And the problem I think a lot of you might have at home listening to some of this is you've heard 1 million people this year already, year to date, say, USIG, I like US investment grade credit. And Lisa, you've also heard a lot of people say this. The US banking sector is resilient, it's really strong, and they said the same thing over the last week. Fact of the matter is, the names we're talking about a week ago were investment grade. They were IG not so long ago.
There's a theory, there's a saying that the crisis always happens in debt or in instruments that are perceived as safe. That is where usually crises stem from. And that, I think, is the concern. When suddenly there's risk in areas that people thought were truly risk-free, that becomes very problematic for broader market confidence.
So First Republic in the pre-market down about 15, let's call it 16%. One eye on Credit Suisse for you all morning, up 25.6% at the moment, Thomas Swiss trading.
So Credit Suisse has done better. I've got that up here, and it has more technological veracity to it. And the answer is a nice spike and then a real surprise. Sell-off errors, people exited 2-3 hours ago. And John, we've ramped up here over 30 minutes, over 50 minutes.
Feels like a lifetime until the ECB decision, doesn't it?
Yes.
It really does. I think we're 3 hours and 10 minutes away from a news conference from President Lagarde.
What we're going to do right now is talk to a bond expert. Ian Lingen has a note that everyone reads on the street with BMO Capital Markets. And this, we're going to break ranks today and not talk so much bonds with Mr. Lingen, but how he folds central bank action into what to do with bonds that you own or that you want to acquire. Ian Lingen, you take great precedence here that Lagarde will speak before Powell. What are the ramifications that the ECB is out front of a Fed March 22nd?
I think that this is the first time in recent memory where we can look at the ECB and really take a cue for what that might mean for the Fed next week. It would have been one thing had it been a limited banking crisis to the U.S. only, but the fact that Credit Suisse is now impacted means that the ECB is facing effectively the exact same decision that the Fed will be next week. So we'll be looking at what's already priced in, which is more than a 25 basis point rate hike, as an opportunity for one way or another someone to be disappointed this morning.
Is Credit Suisse, and for that matter, First Republic, different from Silicon Valley Bank? Are these balance sheet crises or income statement crises, Ian?
I can characterize it more as a baseline confidence crisis. It's more about if it can be contained and isolated, we won't have a problem as a system. But as it seems now, we have gone, this is now the 5th bank in the process that is under pressure, and it's overseas as well as domestically. I think that regulators and monetary policymakers are going to be very apprehensive about the next 2 or 3 weeks.
Jay Barry at JP Morgan says locking the gains in treasuries, they're going to keep hiking. Ian, what do you say back to that?
Certainly in the front end of the market, particularly the 2-year sector, when we dip below 4%, that's implying a great deal of caution on the part of the Fed. A pause should certainly be on the table next week, although, as I mentioned, the ECB will probably set the broader tone. But even if there was a pause, it wouldn't be terminal per se. There would be some symmetry around the risk going forward. Very conceivable for the Fed to pause, but at the same time, increase the dot plot for 2023, which implies restarting later in the year.
Has the Fed lost credibility, though, in all the dot plots and the SEPs and all of the other issues that they try to forecast something that is unforecastable at a moment when the market's moving, whether the Fed does or not?
I think that this is a unique episode for the Fed because of the proximity to terminal, i.e. we're close enough that the Fed probably knows exactly where they're going to end the process. It would be different if we were having this conversation this time last year when there were still a large number of hikes yet to be realized. So if nothing else, I think the market will look at the SEP and the dot plot and say, okay, Powell probably knows exactly what the plan is at this point.
Ian, I'd love your sense of the technicals underpinning the bond market right now. We talked about how the implied volatility right now in Treasury yields is the greatest going back to December 2008. Does this highlight to you a fragility in the market structure of the deepest, most liquid market in the world?
I would say that I had bigger liquidity concerns and was more worried about the overall function of the Treasury market during the fourth quarter, when we saw a lot of strains in a variety of different sectors. But given that we are where we are in the monetary policy cycle, and there's a broader sense of stability, and we've actually seen a lot of sideline investors come back into the market, whether that was during the month of January or even in the most recent week, I think that we're back in a reasonably comfortable position from a liquidity and a market structure perspective, at least. But we are facing a great deal of uncertainty. And when one is facing uncertainty in financial markets, buying treasuries is a reasonable knee-jerk response.
Ian, just to be really clear, do you think it's a mistake for these central banks to isolate what's happening in the financial system from the monetary policy decision they've got to make today and next week?
I would say that it is unwarranted to separate the two at the moment. Taking a breather on the rate hike process is prudent. I think that would make sense, but that doesn't mean that's what they're going to do. So I think it's very much up in the air at this stage.
Well, I think you're very honest. That's the problem. No one really knows. Ian Lingen there of BMO Capital Markets. Ian mentioned something, though, that goes with something we were all told last night from someone much smarter than me, at least, who turned around and said, Chair Powell and President Lagarde have probably spoken to each other in the last 24 hours, which is why people like Ian think that you can infer what the Fed's going to do from what ultimately, Lisa, the ECB ends up doing this afternoon.
I love that, because usually people say Jerome Powell, central banker to the world, the Federal Reserve leading the rest of the world. Now it's the ECB leading the Federal Reserve, which would be really notable. I can't imagine what that conversation would have been like, though. I don't know what to do you? I have no clue.
You go first.
Yeah, go ahead. I'll be watching.
You go first this morning, 9:15 Eastern time. Just want to be careful on the time if you are stateside, because of the clock changes in the last weekend. 9:15 Eastern time is when you get that ECB decision. 9:45 is when Tom will get that news conference.
They don't change daylight savings when we do?
No, a couple of weekends after.
Yeah.
When is the meeting today?
So you're going to get the decision at 9:15 Eastern, and then 9:45, I believe, you get the news conference. You got that?
No one told me. I've been minutes away.
Lisa went through it twice.
Okay.
Yeah, once at 5 and I think again at 6.
There we are. Coordinated central bank response is something they do. It's in the research, and they don't talk about it.
No.
She's going to get a question today.
Of course.
She'll go, how about that Formula One race? You know, that's what she's going to say.
You think they're talking about Jeddah this weekend?
I think they're talking about Jeddah or Ferrari, but you know what they're going to really talk about here is what they're. I know exactly what Lagarde's going to do. Christine Lagarde is going to go, how do I get through this and do no harm? That's exactly how she's going to do it.
We're not here to close spreads.
Yeah.
That was a good one, wasn't it?
I mean, no, the point is...
Tom, yeah, that's the simple one. Do no harm. But Lisa, what does more harm?
Right.
Hiking or not hiking?
This is the question. I mean, what does it even mean to do no harm? What are you trying to push the market? Which direction are you trying to push it in, honestly?
First Republic 30 minutes ago and 40 minutes ago was actually pretty stable, gone under 26 now, down from that 31 level. We are in the crisis now, and that means central bankers don't act. That's the guess.
Down 17% on First Republic. Credit Suisse this morning. Good morning to you. Positive 26% over in Swiss trading. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Credit Suisse surged the most on record after tapping the Swiss National Bank for a $54 billion loan and offering a repurchase of $3.2 billion worth of debt. Meanwhile, Credit Suisse's top shareholder says panic around the bank's financial stocks is unwarranted. UK Chancellor Jeremy Hunt has unveiled a $22 billion a year fiscal stimulus in his first budget statement, easing the belt-tightening he was forced to announce last year. Among the most expensive measures were plans to extend free childcare support, tax breaks for business investments, and extra military spending. Social media stocks rallied in post-market trading following reports the U.S. government may ban TikTok. Now, sources say the U.S. has told the app's Chinese parent, ByteDance, they must sell their shares or face a ban. The U.S. has raised concerns over China's influence over the app. TikTok says divestment won't resolve any national security concerns. And Virgin Orbit is said to be halting its operations and furloughing nearly all staff due to funding issues. Bloomberg sources say the company is planning an operational pause. Earlier this year, its first launch out of the UK failed to reach orbit in a mishap blamed on a faulty fuel filter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I think with Credit Suisse on the table, they will pause. I think they should pause. I think hiking rates, either the ECB hiking rates this week or the Fed hiking rates next week, has the potential to be the greatest gaffe since the ECB hiked rates in June 2008.
Is this a Trichet moment for the ECB all over again? Bob Michael at JP Morgan, Asset Management, the CIO. TK, what do you make of that?
I think it's no secret to anybody. I'm 100% on page with them. The only thing I would change there is it would be the greatest gaffe since the Red Sox traded Mookie Betts. Mookie Betts.
08,
to the LA Dodgers.
And not just 08, but also 2011, the ECB also hiked then.
And,
so
and this is Lisa and I, John.
Lisa
and I were talking. Lisa and I were talking in this break while you were out at the catered breakfast that we've got in this morning. And the answer is they've learned their lessons. Why is First Republic Bank? I mean, give me the quote, John. I don't know where it is.
We're down
right
17
now.
Right now, down 17%.
Yeah, you know, we're breaching down a new weakness on First Republic Bank. Everybody's learned, Lisa, from 08. And from the other crises.
So Bespoke Investment put out this chart yesterday where they were looking at the gap, the yield curve of 3-month and 2-year Treasury yields. And it's the most inverted, or it was the most inverted at one point over the past couple of days, going back to 2001. The last time this happened, the Federal Reserve came out and cut by 50 basis points in a surprise move the next day. Just to give you a sense of what the market is basically signaling here.
Important asterisk, the caveat. Where was CPI?
Yeah. This is the problem.
It's
right?
the big problem for them, right?
Yeah, this is a reason why, Nouriel Roubini had a good point, where they're kind of stuck, where they still have to be thinking about inflation.
I'll say it once, twice, 3, 4, 5 times. I keep saying it. There are no good decisions today.
No, it is
There really aren't, and I don't think it matters. It's sport to beat up on central banks. I love playing the game too, but today, next week, doesn't matter what they do, there will be a reason to criticize them for whatever they've done.
I'm going to channel Mohamed El-Erian on this, and this is game theory where there's no good decisions, so you're trying to ascertain good people with real-time dynamics, including flows out of banks, are trying to ascertain the best, worst outcome. And that's tough to do. Let's drive the conversation forward, and we do this with someone hugely qualified. Sandra Philippin is chief economist at ABN AMRO. Dr. Philippin is out of Erasmus, which means she has a huge understanding of European banking history. As an economist, Sandra, with your knowledge of European banking history, what should Christine Lagarde do in the 9 o'clock U.S. hour this morning?
Yeah, thanks, Tom, for those pretty remarkable compliments that you're making here. That's overdoing it a bit, actually, but well, nobody knows what she should be doing, actually. And I have been listening to your comments in the last few minutes on the table, and I don't necessarily agree with what you're saying, because well, if you just try to decompose the problem a little bit, looking at Credit Suisse, I think the most fundamental metric that matters at this point is the total loss absorption capacity in terms of its RWA, and that is at 40% right now. And that is way above the 25%, 20 or 25% that is demanded from the Swiss regulation. So I think that a lot of drama is going around in headlines at this moment. And so actually, I do think that the ECB has one thing very clearly in sight, and that is that it still has a core inflation problem. It still has a macro resilience that is lasting longer than expected. And it has its previous commentary about going on for longer beyond March. And, to turn all of that around, while at the same time we're always worrying about not being led by markets, I think gives me a little bit of confidence that she will be going ahead with her plan.
Interesting. Oh, there's many different opinions out there right now, to say the least. Sandra, with that said, and with the idea that Credit Suisse has financial integrity, they've still got to go out and do business. Will there be a European nominal GDP spirit that can get Credit Suisse, Switzerland, and all of Europe through this crisis? Do you see an oomph to the European economy?
Yeah, that's actually a really hard question to answer, Tom. But I think that the resilience in the European banking sector is bigger than probably markets are expecting right now. And I think that if you look at, for example, the ECB stress test on fast steepening or fast flattening of the curves that has been done, basically showed a resilient picture. And if you want to look at the least resilient geographies in Europe, it was Luxembourg and Italy, but even that was not dramatic. So I think that for now, I think this turmoil will settle, and yeah, I think the ECB will continue on its path.
So just to be clear, just quickly, Sandra, just in a word, 50 today, is that your call? Just yes or no?
Yes.
Amazing. Sandra Flippant there of ABN AMRO, thank you. She's not alone, Tom.
Well, this is
ECB
the debate.
basically pre-committed to it. Some people think they'll do it.
Our job isn't to form the debate. Our job is to listen to the debate, and that's it. Bob Michael and Sandra Philippin are on two separate planets, which is what makes it interesting.
Well, actually, I think they're on similar planets, because Bob is saying it'd be a terrible decision. He just doesn't know ultimately what they will do. So Bob's been very clear about what he thinks they should do. He just does not know what they
Can
will
I throw
do.
something out here? Does Jerome Powell have the luxury of really not being visible till March 22nd? I mean, we're lucky in that Christine Lagarde, 2 days into this crisis, is visible. I'll give her that. Does he have to come out and make an appearance?
The problem for Jay Powell right now is there's also a bit of scrutiny about their ability to oversee the financial system because of some of the missteps at Silicon Valley Bank and the San Francisco Fed having some relationship with it. So there is this sort of dual question of how are they sort of shoring up their oversight of small and medium-sized businesses at the same time that they're trying to, actuate some sort of monetary policy at a very difficult time. It is a very difficult moment for him.
Yes, and there's also some criticism about how they oversee themselves as well as overseeing other institutions.
Yes.
And Senator Warren's got things to say about that. Tom, down 22% on First Republic.
Can we frame it? 31. John was ahead of me on this story. 2 drops. We've now got a new leg drop to 24. The low 2 days ago was a 17 handle. This was for a cup of coffee. It was a good cup of coffee, but it was a cup of coffee, John. We're at 24.13, more than halfway back easily to that 17.53.
I'm afraid that, Tom, I don't have anything new to add apart from our reporting yesterday evening. Gillian Tan, Matthew Monk said this, that First Republic, after the cuts to junk by S&P Global and Fitch Ratings just yesterday, we're exploring strategic options, including a sale, according to people with knowledge of the matter. And I'll go back to the statement from the bank on Sunday that it had more than $70 billion in unused liquidity, Lisa, to fund operations from agreements that included the Fed and JP Morgan too.
Well, this is according to Joseph Wang, who out on Twitter is known as the Fed guy. He used to work at the Federal Reserve, and he put out this a couple days ago. One reason why First Republic looks like it's imploding could be because it actually can't benefit from the Fed's new bailout facility, that basically they don't own the Treasury and agency MBS to post as collateral.
Yes.
This is the type of balance sheet analysis that people are looking at. So they're clearly out of the regime that's been set up by the federal authorities.
We need to be careful about conflating income statement flow and critically trust analysis with balance sheet analysis. I think everybody involved here has got great balance sheets, including Credit Suisse bailed out by SMB, John, at what, 1:45 a.m. in the morning, the dark of night? Great, but the answer is that's got nothing to do with his present unique and different crises between these separate banks.
This particular situation, though, I think people are looking at this and saying, okay, well, the Fed's offered this issue, the FDIC has offered this program. What can different banks do to potentially access it? And I think people are going and looking bank by bank to understand what the protections are.
I remember the moment when we were stunned that James Dimon showed up to go 1-800-BSC. And as Matt Levine says brilliantly today, they all learned their lesson. And where is the Jamie Dimon to show up for Silicon Valley? Didn't happen. I don't want to speculate on FRC right now. That would be rude. But who's going to show up on FRC, John?
Another leg lower.
HSBC, they showed up.
We're down more than 30% on First Republic in the pre-market. Let's call it negative 32 on my screen right now. More coverage of this still to come. Fantastic guest in the next hour. Don't miss this. Former Vice Chair of the Federal Reserve, currently of PIMCO, Rich Clarida, just around the corner, 30 minutes away.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Why 1953 specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War, it's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you can do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The problem is that Credit Suisse, by some standards, might be too big to fail, but also too big to be saved.
This stock has been in a huge downfall for 2 years. So there are clearly problems within this particular institution.
We simply don't know the degree to which this is systemic or isolated.
As a global bank, there might be counterparty risks for some of the U.S. banks.
If one gets into trouble, people very quickly start looking, oh, what's the next one that looks remotely like this?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
ECB President Christine Lagarde, over to you, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures down about 0.1%. If you are just tuning in this morning, welcome. Credit Suisse is up 24%. Overnight, tapping the Swiss National Bank for 50 billion Swiss in liquidity, talking about repurchasing debt as well. This isn't the only name we're looking at this morning. Here's another one. First Republic in the pre-market, down around about 26% at the moment. At one point, down almost 40 percentage points only moments ago. Tom, this was a $120 stock only a week ago, and now it's trading in the 20s.
It's the way it's down, John. There's no technical analysis this morning on FRC in the pre-market. It is a plunge beginning 5:50 a.m. or so. We breached 20 moments ago, a little bit of a bounce now, but we need to see a bid here above that 17 handle, which was the low on Tuesday.
I've said it a few times already this morning with regards to this company. Very little news around it. We had a report here at Bloomberg that they are considering a sale after being downgraded to junk by S&P Global Ratings and Fitch Ratings just yesterday. I keep going back to the statement, the bare bones we have from the bank so far, Lisa, from Sunday evening, which is basically they said they had 70 billion in unused liquidity to fund operations from agreements with the Federal Reserve and JP Morgan.
The sentiment has a self-fulfilling prophecy, though. I mean, even the downgrades, it wasn't necessarily that they were downgraded to junk by S&P, by Fitch, but why? It's because sentiment is deteriorating and people could potentially withdraw some of those deposits. The customer base could deteriorate in the face of a potential loss in confidence. So given that, you are seeing in sympathy PacWest down about 5%, Western Alliance lower by almost 3%. Is this the beginning of yet another shoe? And this is the concern that people have.
Okay, it's your turn. Get in the middle. Rock on a hard place. You're Christine Lagarde. You sat down, you've had your governing council meeting. The good and the great have all sat around the table and told them each other what they think of the situation and what they should do. Where did they come out on this one?
if I were Christine Lagarde, I'd totally punt. I would just say, you know what, we're going to come back in a week. Right now, we don't know exactly how this is all playing out. Our impression is that the financial market is completely stable, that the financial system is stable. We're going to provide every single facet to make sure that it is, and we still have an inflation problem. We want to raise 50 basis points. We just need to see it play out, and then they wait, and then they do that.
And this is the dynamic analysis we have, and this is like goosebumps, folks, going back 20 years here on Bloomberg Surveillance, to have Richard Clarida with us here, the vice chair, who is literally, as academics, is the dynamics of the economic system. They have Dominic Constam in a moment, and Devin Ryan in between with JMP to talk to us about the securities analysis of the moment. These are people that can deal with the ambiguities, the choices that people have to make.
Very cool. Let's get to those conversations in just a moment. Here's a flavour of the price action. For those just tuning in, your equity market is negative by about 1/10% on the S&P 500, even with a major move on Credit Suisse this morning. Moving to the upside, looking at the Nasdaq positive yesterday, again today, up 0.2% in the bond market. The 2-year, the 10-year, the 30-year, the 2-year looks a little something like this. The 2-year, 3.99, up 10 basis points. Your 10-year, basically unchanged on the 10-year at 3.46. And a belief this morning, Lisa, I think a real belief, that some people look to the ECB to give them some idea as to what the Fed's going to do. We heard it earlier this morning a few times already. I think it was Ian Lingen of BMO who suggested that if the ECB makes a move, then that's probably going to be the template for the Fed to do the same thing.
Is ECB now the central banker to the world? Can we say that yet? I don't know about that. All right, meanwhile, this is what we're watching today. We're watching.
That dead, didn't you? Just cut that dead.
No, I don't think so. I think Jerome Powell's here, and I would like to see some visibility. I think it would be timely at an appropriate point in a prepared statement for him to provide confidence to the system, as Secretary Yellen did a number of days ago.
You want one of those statements that says we're watching things carefully and we think things are resilient. You want one of those?
You and I think it's stupid, but I think in the public in crisis, it has value.
Okay.
Right now, we're not necessarily seeing the confidence build too much. What I'm watching this morning, among the different actions and activities, I'm watching European bank stocks, and they were up at one point as much as 2%. Now they're up only about 1%, 1.2%. So really, you've seen that move fade over the morning. After yesterday, we saw the biggest decline going back to March of 2020. Then, of course, at 9:15, this is the real key issue: ECB rate decision. What does Christine Lagarde do? The press conference at 9:45 a.m. How do you do no harm? I mean, we were talking about this earlier. Hard to know what that real option is, the least of worst options, Tom, as you put it. And at 10 a.m., U.S. Treasury Secretary Janet Yellen gets a turn. She's going to be testifying in front of the Senate Finance Committee. I don't understand exactly what she can say to give some sort of sense of confidence.
Maybe she'll say a note for Powell.
Yeah. I mean, really, does she give some guidance on what the central bank should do? It's going to be important and market moving, what she says.
If I'm Lagarde, I've got that statement in front of me, and I just read it verbatim and just keep returning to it. And just keep returning to it. You just don't want to say the wrong thing.
I have laryngitis.
Yeah,
I'm sorry.
That's a good one, too.
Continue.
Dominic Constam does not have laryngitis. He's got to make a call. He's the head of macro strategy at Mizuho Americas. Dominic, let's start here. ECB first. How much daylight is there between what you think they should do and what you expect they will do?
Well, not too much. I mean, I think they are a little bit behind the Fed in terms of raising real rates and fighting inflation. So if I were to expect the Fed, for the sake of argument, to stop, and the ECB was expected to raise 50, it's pretty easy for them to just scale that back and sort of signal that they're almost done. But I would expect them to sort of still push rates a little bit higher.
In famous Constam 2020 hindsight, Dominic, you absolutely nailed it. On this show a number of weeks ago, you pounded the table, a lonely table, saying they are super restrictive. As they go into these set of meetings, are they still super restrictive?
Yeah, I mean, financial conditions are actually tightening through all of this. The idea is, I don't know if you recall last year, there was this Fed paper talking around sort of R double star. That's, we won't know it until we see it. And I think the idea is that we're seeing it now, that rates have basically beginning to sort of break aspects of the financial system, particularly in the US, which is a different situation than, say, Europe. Yeah, I mean, absolutely super restrictive. I think it's part of the speed with which rates have gone up. So you can sort of maybe revisit these levels in a more calmer tone, but the fact is, if you want to fight inflation, you better sort out your financial system first. You can't fight inflation and solve the financial system at the same time by raising rates.
Dominic, we're expecting to hear from Janet Yellen later this morning that everything is fine in the financial system, that we have real resilience. What would it say, from your vantage point, to risk markets if the Fed comes out and says, you know what, we were wrong, inflation isn't the preeminent concern, and even though everything is stable, we're not going to raise rates anymore? Don't you think that that could potentially be a liability for some of the riskier assets?
Well, the issue for the financial system, in a sense, if you say it's fine from a capital perspective, that's largely true. But obviously, it's from a liquidity perspective that you've got the issue, and we saw it in the gilt market last year, whereby liquidity problems can become solvency problems for, in that example, the insurance sector, and that's what you're seeing in the medium-sized banks. So it is true you can say financial system is fine, but you've got to focus on liquidity, and on that basis, you have to kind of when the liquidity problems coming from the so-called risk-free rate and the treasury yield curve that's attached to that, then that's your problem. So you can't basically fight inflation. And I agree that does maybe give people a cause for concern around the credibility around inflation. But the other thing that we've been arguing for a while is that this inflation is sticky and it's almost beyond the control of the Fed. There's a time element with which inflation will come down that the Fed can't necessarily control.
Dominic Constam, you invented the linkage of quantitative finance into economics at Credit Suisse with Neil Sass years ago. You do have experience at Credit Suisse, to say the least. Can you imagine UBS merging with the Credit Suisse
Oh, absolutely, yes. I mean, that's, I think that's the... I don't think, what the Swiss National Bank has done is obviously extremely important, a massive liquidity facility. There are a lot of idiosyncratic problems, obviously, at Credit Suisse. It's kind of fairly intuitive that in the long run or the medium term, some sort of resolution would involve the Swiss banks finding some kind of tie-up. Good bank, bad bank, whatever you want to call it. The main thing about Credit Suisse is they have a wonderful private bank, and that's what they kind of want to preserve. An investment bank is, it is what it is.
Would that private bank be valuable to other UK, continental, or American banks? I mean, there's a mystery here to the new culture of Credit Suisse. Do you denote a new culture?
Yeah, I mean, I'm not a bank analyst, but I mean, I would say the private bank has always been the sort of jewel in the crown, and it's been very impressive, and I would absolutely imagine it would be attractive to a lot of people. Yes.
I think we're all bank analysts this week. Dominic, thank you.
Foxhole.
Dominic Constant, thank you, sir, of Mizuho. Lisa, you've talked about this all morning. We're going to hear from Secretary Yellen today in front of the Senate Finance Committee. We've got some text of her prepared remarks, and here's the quote. I can reassure the members of the committee that our banking system remains sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure, Lisa, that depositors' savings remain safe.
So herein lies the question for Jerome Powell. If this is true, then does this mean that they have the option of pausing or even signaling rate cuts in the near future if the financial system is sound? I mean, can there be a sort of nuanced argument made about the tightening in financial conditions in the heels of this that accelerate the process, that don't necessitate them raising rates? Or will that send a message that could potentially be really problematic?
There's another point here, and it's not been made official, but it's implied by the actions of Sunday and this quote here. The resolute commitment to depositors, all depositors, above what is still meant to be the FDIC limit of 250,000, right? Is that gone now? Are we guaranteeing all deposits in America?
And at what cost, right? I mean, this is the issue that people have been talking about. Are they going to charge a premium for insuring deposits above $250,000? Are we seeing a fast-moving policy before our eyes that they're basically coming up with in real time, and they're going to figure out the details later?
Feels that way.
Are all banks in the same pool, or is there still a distinction of small banking in America?
That's an important question, Tom, that I don't have the answer to. Looking at First Republic, down 27% in the pre-market. Looking at Credit Suisse, up 23%. And those two names dominating the conversation so far this morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Pentagon released video showing a Russian aircraft intercepting a U.S. Air Force surveillance drone in international airspace over the Black Sea. The Pentagon says the Russian Su-27 approached the back of the MQ-9 drone and released fuel as it passed. The military says it discarded the drone in the sea after the Russian fighter jet poured fuel on the unmanned aerial vehicle and then struck its propeller. The chairman of the U.S. Joint Chiefs of Staff, Mark Milley, says doesn't know if the event was intentional, but he says the Pentagon video suggests Russia's actions were aggressive. Defense Secretary Lloyd Austin and his Russian counterpart, Sergei Shoigu, spoke yesterday in what appeared to be an effort to reduce tensions. The European Union will provide a clearer legal framework to target family members of sanctioned Russian billionaires. It's an important shift after the EU court annulled penalties imposed on the mother of a close ally of President Vladimir Putin. The European External Action Service, the bloc's foreign service arm in charge of listings, told member states it will submit legislation soon. In London, commuters are facing disruption for a second straight day as rail workers strike across the country. Services into the capital will be restricted as workers across 18 companies represented by the RMT union walk out over a pay dispute. Yesterday, about 500,000 British workers staged a mass walkout, time to disrupt Chancellor of the Exchequer Jeremy Hunt's annual budget speech. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
With inflation persisting and questions about the financial sector looming, how will the ECB respond?
I think they have a difficult situation, but I wouldn't be surprised if they go for a 25 basis point hike rather than that 50.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
How much financial instability has translated across the Atlantic is a huge question right now.
Coverage begins today, only on Bloomberg, your global business authority.
Anything will happen to Credit Suisse will be of systemic effect for not just the European financial system, but also for the global financial system. So if Silicon Valley Bank create the ripple effects in the global financial market, something bad happening to Credit Suisse will be an order of magnitude more severe, something more like a Lehman moment.
That was a brilliant Nuria Rabini of Rabini Macro Associates, the chairman and CEO. A better morning for Credit Suisse so far, at least. Good morning to you. The stock is up by 22%. A statement of confidence from the regulator and the Swiss National Bank yesterday afternoon. And then overnight, 1:45 a.m. Zurich time, they tapped the S&B for 50 billion Swiss and intend to buy back some debt as well. So far, so good. Better, certainly better than what we saw yesterday, but still in and around 2 Swiss francs per share. on the stock. That's not the only stock we're looking at this morning. First Republic, another one. It's down 30% in the pre-market, downgraded to junk from S&P Global Ratings, Fitch as well. All of that yesterday. Our reporting yesterday evening is that they might be mulling a sale. That stock is down 30% in the pre-market. It was 120-something a week ago. It's in the 20s now, wow. So that's a big turnaround in the last week or so. Janet Yellen, Elise has talked about this all morning. The Treasury Secretary is going to go in front of the Senate Finance Committee a little bit later on this morning. What was that, 10 a.m.?
10 a.m.
Eastern time. So
what's the date
looking
calendar?
Forward to
Lagarde's in the 9, not the 8. We have the decision when? 9:15?
9:15 Eastern is ECB.
When is Lagarde's?
45 is when the news conference starts.
And then Yellen
so
in 15 minutes.
So you're going to have two screens. You're going to have Yellen, and then you're going to have Lagarde at the same time. Personally, I'll be watching President Lagarde. We've got a flavour of what we'll hear from Yellen.
I agree.
Already, the Treasury Secretary putting out some text of her prepared remarks. Here's the quote. Let's get that quote up again for you if you are just tuning in. This is what Treasury Secretary Janet Yellen had to say. I can assure the members of the committee that our banking system remains sound and that Americans can feel confident their deposits will be there when they need them. She went on to say, this week's actions demonstrate our resolute commitment to ensure that depositors' savings remain safe. Now, a question that Lisa and I were exploring about 10 minutes ago, Tom, is whether there is just an implied guarantee for all depositors now in the whole banking system across the whole of this country.
I don't hear anybody talking against that. I mean, the fact is, is that a given?
Feels that way. Haven't made it official. They're certainly implying it, though, with language like that this morning.
We're going to have to see. Dominic Constant with us here, of course, formerly with Credit Suisse and now with Mizuho, was just wonderful. The former vice chairman of the Fed, Richard Clarida, will join us. And between them is a tour de force of smaller bank analysis. Devin Ryan was iconic at Sandler O'Neill years ago, as we talked to Thomas Shode of Keefe Bruyette a few days ago. Now with JMP Securities, Devin Ryan joins us this morning. Devin, I'm going to cut to the chase. In your South Bend, Indiana, there is First State Bank, and on their website, they have hometown values since 1910. Are we going to end up where all banks are treated the same, that First State Bank of South Bend is treated the same way as JP Morgan of Park Avenue?
Hey, good morning, Tom. I don't think we're necessarily going that far. You know, I think there needs to be small banks and regional banks, and the regulators don't want to see all market share go to the top 4 or 5 companies in space. So I think that there will be a balance, but I think the big question in the market right now we're talking to our clients about is what is next? What type of regulations do come? I think there's an expectation that there will be change coming out of this. That could add expenses for most banks. That could change asset liability mix, and then people are going to be conservative on the other side of this as well. And so those are, I think, a lot of questions in the market. But what the Fed and FDIC did, I think, was necessary and really kind of, I think, stopped a more systemic, bank run. And so we feel good about that. But we do think that kind of now the questions are what comes next year for the system.
Devin, do you think that guarantee to depositors, regardless of size, do you think that's implied now?
Yeah, I think effectively it is. And if it isn't, then it potentially would be if things got worse from here. But I think that what the Fed and FDIC did was enough to kind of, I think, assure depositors that their money's safe. And really, bank runs are a confidence thing. And so we saw what happened with Silicon Valley and some of the reactions since then. In our opinion, what's happening is now we're kind of moving to an earnings story, and interest rates are moving lower. Credit is now kind of front and center, and money did move around late last week, and so some of the banks that are in the press potentially, money did move around, and businesses are going to be more conservative around what banks they're putting their cash in, and so I think all those factors are playing in to the sentiment right now.
Devin, different banks, different problems. What would be the distinction that you drew between, say, SVB, First Republic, and then Credit Suisse, which just feels like a different beast altogether? What's the big distinction for you?
Yeah, well, I think the big distinction is, first off, Silicon Valley, I think a first-year banking analyst can understand their balance sheet, very simple, and you understand where the issues were created. Credit Suisse is a much more complicated, entangled financial institution. I think that's where kind of there's more fear, with CDS blowing out yesterday. It's just how complicated this bank is and how intertangled they are to financial markets. And so, I don't cover them, so I don't have a strong view there, but I appreciate where kind of that's a separate dynamic. And that's a little bit more for my seat around kind of credit concerns SVB was kind of a duration mismatch and pretty simple in terms of what the issue was there. So I think that's a couple of the big differences.
That said, Silicon Valley Bank has put a spotlight on the credit profile of a number of smaller and regional banks. And Torsten Slok over at Apollo just put out a chart of some of the exposures and the differentials between big banks and the smaller ones. There is much more exposure to consumer credit, to bank loans, to commercial real estate at some of the smaller banks than at the large institutions. How much is this becoming a credit concern in an era of tighter financial conditions and higher rates?
Yeah, Lisa, it's a great question. I mean, I think that's exactly what this is becoming, whether it's deserved or not. I mean, the banks have been managing through thus far incredibly well. The balance sheet dynamics that we're talking about, even at Silicon Valley and other banks, are things that, as analysts, we look at and have been talking about for the better part of the last year. So a lot of this is not new news, but it is front and center. I think there is, obviously increasing concern around economic conditions and, the tighter backdrop, and so what that could mean for credit. I think this comes down to, as it always is, risk management, asset liability management, and good banks are going to come through this. And actually, good banks take advantage of these moments and gain market share, gain depositors. And I think that's where the barbell is here, that, companies that didn't manage well are going to be penalized, and companies that did, when the dust settles, will come out of this in a good spot on the other side.
Devin, how analogous is this moment to the S&L crisis that we saw back in the 80s?
Yeah, I think, every crisis is different and feels different, but there's always, I think, some of the similarities and just this sense of fragility right now. And just when you have an announcement like what occurred over the weekend, that's destabilizing to markets. And so ultimately, that brings risk profiles in. People are going to be, I think, more conservative in the very near term. And, just investors that we talk to, people generally move to the sidelines when, there's headlines every day, every morning, trying to keep up with it's exhausting. And then also, in a lot of cases, doesn't directly have anything to do with maybe a stock in their portfolio. And so it's a really challenging time. But as I said, we feel good. I think what the Fed and FDIC did very quickly was important to stabilize the broader system. And now you can start to focus on individual names. And Lisa, to your question, where credit risks do they lie? What are the effects of kind of lower interest rates here to the extent that's the direction we're going? And so there's a lot of factors here, but good firms will come out of this in a good spot.
Hey, Devin, thanks for being with us. Devin Ryan there of JMP Securities. Thank you, buddy. Looking at First Republic down about 27.6%. We'll turn top of that story for you. That's the story in the pre-market, at least for that single name. Tom, we said this a little bit earlier this morning. If these issues had developed several decades ago, this would have led to a major crisis almost immediately, because policymakers wouldn't have had the whereabouts, wouldn't have had the tools, wouldn't have had the experience, wouldn't have had the speed that they reacted to this in the last week.
I strongly agree with that. They have the much better macroprudential tools now, and the speed thing. Well, we learned a little bit about Twitter over the weekend.
Oh wow! Didn't we just? Didn't we just? Tension simmer. It's a slow grind this morning, that's for sure. The ECB decision a few hours away.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
There are just no quiet mornings anymore, are there?
No.
They just don't exist. Good morning to you. Equity futures down about 1/3 on the S&P 500. Credit Suisse up 21%. It's doing okay. Still in and around 2 though, isn't it? Got absolutely hammered yesterday. We saw the statement of confidence, if you will, if you want to describe it that way, from the Swiss regulator, the Swiss National Bank. Then the follow-through from Credit Suisse overnight, tapping the S&B for 50 billion Swiss of liquidity, pledging to repurchase some debt as well. So the stock's doing all right for now. Equity futures, as I say, still lower though, down by about 1/3 on the S&P, and the Nasdaq up 1/10%. 9:15 Eastern time for an ECB decision. 9:45 is when you get that news conference with President Lagarde as well. So all of that good stuff is about an hour and 45 away. And the bond market going into it, 2s, 10s and 30s, look a little something like this. The 2-year up 8 basis points, 397. Least of the 2-year, and that's what a quiet morning looks like for the 2-year relative to what we've seen. The storm of the last week in the bond market has just been unbelievable.
It's unbelievable how much we've retraced the potential for rate hikes, and not just that, but pricing and rate cuts of nearly 100 basis points over the next 12 months.
Well, that's a 110 basis point move in the last 6 days.
So let's see what the next couple days. When you said,
nuts,
you know, every morning doesn't seem like a quiet morning. Are we in 2025 yet? It feels like every day is a year. Let's take a look at some of the other banks that are moving. You talk about Credit Suisse, you talk about First Republic in California, and this is the contagion of the moment where people start to look around and say, who is next? PacWest, which has seen a lot of volatility in those shares, down another 14%, I should say. It's moving as we speak and deepening with the losses of First Republic. Western Alliance down more than 11%. First Republic, we're tracing some of the lows of the morning, but down 25%. I mean, really, it just keeps bleeding. And Comerica down about 3%. We've been talking all morning about the banking system because that really is where the focus is. That has the most and potential to disrupt monetary policy. I do just want to look at this because overnight we did hear CFIUS, the Committee on Foreign Investments in the U.S., recommend that TikTok's parent company sell their stake in the video sharing app or face a possible ban. Snap shares just ripping. Snap shares up more than 7% on the heels of this. A ban from being used in the United States.
By people, like my kids.
Correct.
Oh, very
So
cool.
it would either, don't get too excited. They're thinking about potentially selling it. But either way, Meta shares up about 2%, and you can see Snap shares up about 7%.
We welcome all of you on radio and television right now. Extended coverage by Bloomberg Surveillance today of this crisis at hand across the Atlantic and here in America as well. We're thrilled to bring you now for this entire half hour Richard Clarida, to say that he's a former vice chairman of the Federal Reserve System. His work at PIMCO also misses his work at Columbia University as Dean of Economics and his academic work on the oddities of dynamic stochastic general equilibrium theory. Right now, that doesn't matter. Dr. Clarida, thank you so much for joining us this morning. DSG is out the window along with the theories now. At any central bank, and particularly at Chairman Powell's central bank, does bank supervision take strong precedence before monetary theory?
Well, Tom, you certainly need strong bank supervision in all seasons, and I think clearly this episode indicates that there's more to do on that front. Chair Powell has indicated that that they're going to be looking at this, and I think the broader situation. You know, ideally, monetary policy can focus on inflation and unemployment, and supervision and regulation can focus on financial stability. But there are occasions when the two are very tightly related, and that's certainly where we are today.
To be delicate about it, and I know is outside the public sphere now, maybe you don't want to comment, but John insists you do. Is this a point where central banks, including Christine Lagarde in Frankfurt, they need to pause?
Well, it's certainly a live option. You know, oftentimes the schedule works out so that the ECB moves the day after the Fed. This spring, they're moving a week before, and I do think all eyes on the ECB, because if Lagarde and her committee do decide to pause, I think that has some potential implications for the Fed next week. I think it would make a pause by the Fed more likely.
I categorize you and Adam Posen of the Peterson Institute, along with Michael Berta at Humboldt University, as our experts on Germany. You've done a great academic work on Germany over the years. How does the Bundesbank respond to this crisis? I mean, Nagel has all that heritage of Axel Weber and the rest. Richard Clarida, are we going to see in 1 hour the Bundesbank reign supreme and say, no, we stay on track to fight 7, 8, 9% inflation?
Well, Tom, it's not just the Bundesbank now. You know, the overshoot in inflation in the Eurozone happened after the U.S., but on a core basis, it's comparable. So my sense right now, and of course we'll know soon enough, my sense right now is that they do go ahead and hike at this meeting, because I think the challenges of managing a pause are not easy when you're pausing when inflation is well above the desired level. You know, if we were 10 years ago and we had this disruption in banking, I think all central banks would be happy to do an extended pause, but they have to really be concerned about their inflation credibility. So I think that will be a relevant consideration.
Richard, part of the conversation, and good morning to you, and thanks for being with us. Part of the conversation over the last week has essentially been there is a risk of not doing something too, that maybe you can spook the market just as much by not moving when you had intended to hike 50 basis points. You've confronted delicate moments like that in the past. Is that something that goes through your mind as a policymaker?
You know, John, it's a great question, because we confronted that in almost exactly 3 years ago today in March of 2020. We cut rates before the scheduled meeting, and then we did so again on that Sunday, March 15th. And in both cases, the initial market reaction was, what the heck do they know that we don't know? It turned out to be a negative for risk sentiment. I can't speak for my former colleagues, but certainly if I were there, that would be on my mind, especially since the inflation numbers that we got this week show you that, if anything, the inflation prints are moving in the wrong direction.
That said, Rich, and this is really one of the conundrums for a lot of people, there is a fundamental tightening that is occurring at a rapid pace when you look at some of the smaller and regional banks, considering how big a role they play in corporate credit, in commercial real estate, in the broader credit complex beyond institutional loans. Is that enough to accelerate some of the disinflationary force that the Fed is looking for?
You know, we think so. We're looking into that a lot right now. An important driver of the business cycle is the credit impulse. You know, until recently, the talk in markets has been the Fed's not getting any traction from these rate hikes. And we're now seeing that traction. The inverted yield curve and the situation of many financial intermediaries means the Fed is getting traction. I think if this persists, and I expect it will, what it does mean is we may begin to see the disinflation kick in sooner than otherwise. And if we start to see that, the Fed probably will take that into account.
Does that mean 100 basis points of rate cuts, I should say, in the next 12 months?
The short answer is too soon to tell, because up until now, the mantra coming from the Fed is they need to keep them there for an extended period. But again, this is a fluid situation. And if you do see a real cutback in lending, that will begin to show up pretty promptly. And in particular, Lisa, if inflation does start to come down durably, then that'll be a factor. Whether or not it's 100 basis points, I won't get into the exact pricing right now.
Well, Richard, I love leaning on your experience of all of this because, as you know, this Fed has to put together the projection materials. They've got to put together an SEP in this environment. Richard, how on earth do they do that?
Well, the short answer is, with great effort, and oftentimes the SEC projections are pretty straightforward. John, in March, I hate to keep coming back to that, but it is recent and it's not relevant today. In March of 2020, and I'm not saying there's an exact or even close parallel, there's some parallel. In March of 2020, we actually just didn't release projections at the March of 2020 meeting just because of the huge uncertainty. Right now, I don't think they will take that step. Again, that could be interpreted adversely. What do they know that we don't know? The projections are finally balanced. As you know, if you count the dots, it would only take two participants from the December meeting to move up to actually have the dots shift up by 25 basis points. It'd take a lot of folks to move down to get the dots to shift down. So yes, as we were saying on these things, this is a very high stakes meeting for the Fed next week.
Richard Clarida, out on Twitter, there's a sport saying we got to look at 14 years of QE and really ask, was this a successful experience? Let's take it to the wonderful David Folkerts-Landau at Deutsche Bank. Professor Clarida, was a negative interest rate model a successful experience?